How you doing, team? First up, I hope you've all had a chance by now to listen to the previous episode, which was my interview with Edward Thorpe. I mean, the man is a real-life superhuman. He has such an incredible story. If you haven't heard it yet, please make sure to check it out. Now, anyway, on this episode, I'm joined by George, who also goes by @RollyTrader on Twitter. George is an Australian equities trader with a momentum/swing trading type of approach. In the past, George has held a few finance-related positions, but since late 2009, he's mostly been trading independently. During the interview, George and I got speaking about lessons he learned early on, the effect that coaching and mentoring has had on his trading, specifics about the setups that George trades, and also his involvement with venture capital, which was pretty cool to hear about. And as we do get quite specific on trading setups during the interview, I just want to give a friendly reminder, and that is you are entirely responsible for your own trading decisions. Please remember this, guys. And that's it from me. Please welcome George for episode 110.
Just shutting down now for a public holiday tomorrow, so just running through a few charts for Friday.
Excellent. Yeah, we've got Australia Day tomorrow. Any plans?
I am having a couple of people over here, so just with the family, with the children. Nothing too exciting.
Good stuff, man. Good stuff. Well, I'm also pleased to say that you're my first guest after however many episodes, 100 and something episodes, that's from New Zealand originally, although you're also living in Australia now like I am. But yeah, very cool to have someone else who's from New Zealand on the podcast. Finally, I knew it would happen one day. So tell us a little bit about yourself. How did you get interested in trading? When did this sort of start for you?
I guess I was introduced at a pretty young age with just with the family at home. We used to have a sort of a trading competition when we were about 4 or 5 years old. I have a brother 11 months older than me, so we're pretty competitive, and Dad gave us $1,000 in the account, and we'd sort of go through the newspaper every morning, and which was a day delayed, the data obviously, and pick a stock, which normally would be one that sells ice cream or something you'd know, and we'd track the prices. And I think that probably at a young age installed an interest. And then after university, during university, really got into it. So that was 2001. So it was an interesting time in the markets there to start sort of learning and going through everything. And then I've really been sort of full-time at it since then.
Excellent. So was your dad a bit of an investor himself then?
He was. He's certainly not a trader, or he dabbles in the stock market, but no, not as a trader, which I guess is sort of what I do today. He just has an interest in business, and probably sort of wanted us to have an interest in understanding value or perceived value.
Okay. And so I've got to ask, who won out of you and your brother? How'd the competition play out?
Well, I believe I won, but we'll let that be a debate for the Christmas table. But he got a little bit bored of cutting out the numbers and sticking them on the wall. So I don't actually know what happened to his account. It might have had a good compounded return by now if he held Telstra, the New Zealand teleco stock.
That's funny. So you said you got really serious about trading, a little later in life at university. What sort of things did you start doing? When you say you started to get serious about it, what did that sort of look like?
I had a friend who was a few years older, and he was trading, and he was a good rugby player and a very competitive person, and he just sort of, I guess, sold me on the idea that it was the ultimate game. And I'd always been interested, and I guess was learning about it probably more from the economic standpoint rather than a fluid market standpoint. And so I went and spoke to my father and one of his friends, and he said he knew someone who was a asset manager in New Zealand. He said, look, why don't you go and have a chat with him? He'll be able to tell you, how it really works. So I did that, and he put me on to a few books, which started at the Market Wizards, the first edition they did, and I read all them, and I guess from then on in, I knew it was for me, and the journey started. Just read everything I could, and I had an account open, but it hadn't really been doing anything, and you were kind of throwing darts. And I guess with the progression of technology, you were able to, for someone who wasn't 100% committed, able to start studying with real data rather than just reading. So that got me going. And then when I had the ability to put a bit of money into the account, did that, and then went from there.
Right. So how did that conversation go with the asset manager you spoke with in New Zealand?
Well, he basically said, this will beat you up if you try and do this, and this is what you need to focus on. And he said everyone thinks they're going to get rich quickly, but it's just not how it works. And if you have that mentality, you'll be refunding your account very often. And they were certainly more of a conservative, big fund manager. And so he said you need to firstly pick your style of what sort of trader you want to be. Do you want to be a conservative investor? Do you want to be fundamentals? Do you want to be momentum based, a day trader, currency, stocks? So I think a lot of people actually, certainly ones that I've helped or have seen over the years, they take too long to pick exactly who they are in the stock market, and it causes style drift, which I think is a big issue for traders in their first few years. They'll be day trading the index and then calling themselves a stock investor, or trading the Aussie dollar, and it just doesn't work. You've got to dedicate your life to one asset class, as far as I'm concerned, and maybe you'll be able to master that after a while.
So why do you think that style drift actually occurs in the first place?
I don't think it does with professionals. Certainly the people that have trained me don't. They trade one style or one asset class. Obviously it can happen in bigger organisations, but you'll normally have a specialist for each individual class. But I think it's people staring at a screen with lots of flashing lights coming at them all day long, who read a tweet or are listening to CNBC and hear, the Aussie dollar's going to do something tomorrow, or it's doing it now. And there's just that temptation to gamble, because, if you've got a trading plan, you won't be trading currency and stocks and commodities. Well, 99% of people won't be. The exception to the rule, who can do it, that's fine for them, but the market works on probability rather than exceptions. So, in my opinion, it's better to choose, at least narrow it down to a currency trader, a stock trader, and then you can hone in on your style.
So that would be sort of your advice for preventing or reducing the temptation of style drift, is to just pick one asset class and really sort of zoom in on that.
Absolutely. Just the mental and emotional costs. I've made every mistake there is as a trader, so I can speak from my own experience. You'd be trading, the stock market, and you'd have your 5-minute chart maybe of the XJO or the E-mini or whatever it was up there, and you might see a trade which potentially makes sense, and all of a sudden you're day trading the index, and you can't be focused on so many things at one time. And I'd noticed that I would really just be making the broker money, losing a bit here, making a bit there, but all of a sudden I'd miss that one or two trades, which, would be the good trades in the stock account. So it's not what a newcomer to the stock market should be doing. And the temptation will be there. So one of my mentors always said to me, he doesn't even look at the index. He said, if you can't tell what the stock market's doing by how the leading names are acting, you shouldn't really be a stock trader. And I think that's very true. And I had to go through a period where I actually just shut off the index and didn't look at it, because there was just the opportunity to trade it was too great. And once I stopped doing that, my results really started to turn, because all of a sudden I could narrow my focus down to one or two particular setups and just try to master them.
Yeah, okay. And I think the key word in your response there being focus for sure.
Yeah.
Now, the asset manager you spoke to in New Zealand, you said that he recommended a few books that you read, those, of course, being some of the Market Wizards books. Do you remember what any of the other books were that he recommended to you?
The Livermore, the Reminiscence of a Stock Operator, and then the shorter book, I forget its name. And then I actually went from there and sort of found who these Market Wizards were, and if they had then gone on to write books. And a few of them had, so started reading them, and I guess got my style sort of based off the William O'Neill Can Slim model, and then that slowly progressed on to people like Mark Minervini and Gil Morales, who I guess have a slightly more refined and updated version, and that's really my exact style. I copied them, have added a few of my own little intricacies and adopted it for the Australian market.
Now, at some point, I presume we're probably jumping forward a couple of years, you actually picked up a job working at an investment bank. Can you tell us a bit about the sort of things you were doing inside of the investment bank?
Well, I was on the M&A side there, and we had a trading division, so I sort of found myself hanging around the trading division the whole of the day. We were in the corporate finance side, so when I moved back over to Australia, got on to an institutional desk at a firm here, advising a couple of institutions and writing reports for them. So I guess that's when it started to get serious, and that gave me a really good insight into how the big money moves, where they're buying, how they're buying, and why they're buying.
Right. And you said when we were speaking prior to now, you said that a lot of the people who were on the desk with you and who you worked with laughed at the idea, or almost laughed at the idea of using charts. Can you tell us a little bit about the mindset there?
Yep. I think there was over 100 brokers, brokers would be the right word, and I think we had one technical analyst, and there was probably 15 fundamental analysts, and there just wasn't much attention paid to any of the work done there. And the firm was sort of a traditionally old Australian brokerage, where it was blue chips. There was a couple of small cap operators there who did this, but yeah, it wasn't. I never went to a morning meeting and heard anyone say, the sector's setting up, there's a whole bunch of names about to move, this chart's breaking down. It just wasn't discussed. And by that time, I felt reasonably comfortable trading with charts, and I just couldn't get over it. And especially through the GFC, when you could, it was pretty obvious looking at the charts that the market had topped, even if you're 3 months late on it, that you're in a bear market. And I just saw, so many people, not necessarily at that firm, but just wherever, just buying those first dips, buying the second dip, and they got their head torn off. And it's just something that you can avoid, I think. I mean, you might get sucked in and trade a couple of the rallies back in, but the good traders wouldn't. The good traders made money in that year rather than lost 60 or 70%, which sadly happened to a lot of people.
So when did you decide to go out on your own, and when did you actually feel comfortable to make that leap, if you will?
I went out in late 2009 and traded for myself for a while, and then started trading for a private equity firm. And I was probably more lucky than smart, but was able to piggyback on the back of the gold equities run, and the rare earths were very strong sectors in that sort of 12 to 18 months. So we were lucky that we had a good couple of years, and then that allowed me to completely go out on my own after I'd done that.
Now, at some point during all of this, you had a mentor, which you've already kind of mentioned, Mark, how do I pronounce his last name? Minervini? Mark Minervini?
Yep.
He was featured in one of the Market Wizards books, I believe. How did he kind of help you out? How did you come across him? How did you get to know him? Tell us a little bit about how that came about.
Well, first, my wife and I, she was my partner at the time, we moved over to Argentina. There was a guy who I knew who had managed a fund for Soros for a while, and he was over there, and I thought it was a good chance to go and pick his brain. And we were starting to trade the US market, so the time zone worked. And while I was there, had made a list of the best traders that were alive and sort of wrote them, letters or emails or read their books, however I could get in communication with them. And the first one actually to respond was a guy, Mark Cook, who was also a market wizard. He was a day trader. And he responded, and so I went over to Ohio to see him, and he trained me up in I guess, day trading. He was just the most amazing day trader. It didn't fit my trading style, but certainly learning the discipline and his daily ritual and how he views the market, and almost the simplicity in what he does. I was still 26, 27 at the time. You kind of think there's this edge that potentially these big guys have that you just, you might not ever get, or you might not be able to get. And after that was a big turning point in my trading when I saw how he traded. It was just so simple, yet he will probably go down as, one of the greatest day traders of all time with an audited performance. And so that was a huge turning point for me. And then with Mark Minervini, it was the same sort of thing. Read his books, got in contact, and he said, look, we do, some programs once a year, or they just started doing them. So went over and did that. And I went back last year actually to see him, and they do services and stuff like that you can subscribe to online. But I think as a new trader, getting that early mentorship or direction from someone is just so important, because you can spend so long making so many easy mistakes, and you're always going to make them. But at least if you have someone guiding you or giving you a blueprint, you should be able to identify when you're making them earlier and hopefully stop them. And so, I learned so much of those two guys. Over the time I subscribed to Mark's website now, he puts a few of his trades up and does a great webinar every week. It is quite expensive for newcomers, so that might not suit everyone, but there's certainly a lot of decent people out there, and I think it's important just to find someone with an audited performance, and if it suits you, you can start to sort of mimic their style. And then, of course, you'll adapt that as you go on. But, there's no need to reinvent the wheel here. There's, since Livermore to Davos to Wyckoff to Morales to Minervini to O'Neill, there's not that many deviations in their trading style. Of course there is, but they're looking at the same things: good stories, good charts, pivotal points to buy them, controlling the risk.
That's really incredible. I no idea that you knew Mark Cook and had traded with him. That's really cool. And I'd like to go back to that point, because you said that you were there, you were on site with him, and you saw him actually trading and how he does things. At what point did you know that day trading wasn't for you? Mark Cook is a day trader. He was showing you sort of how he goes about things. And even though you said it was a very simple, what he does is so simple, you still said that it's something that just still wasn't for you. How did you know it wasn't something for you?
Well, I had day traded before then, and I sat there live trading with Mark, and so I could mimic his trades, and he gave us his 5 or 6 setups. So you knew exactly what he's doing. The time zone was a bit of an issue when I came back to Australia, because he really was the bonds and the E-mini. and didn't move outside of them. That was it. And he was the master of those. It didn't work with my personality. I don't like writing the ticks. I like to be able to buy something, put my stop in or my alert in, whatever I might have, and go and have a cup of tea, or go and do something which isn't just staring at the screen. So day trading was never going to work for me, despite the fact that I'd trained with one of the best guys there is. I don't think I would have been able to make money out of it. My personality would have lent to me not following the system well enough, because if you're day trading, you can't have any deviations from your rules. I think the stock market's a little more forgiving and a little more flexible. So for someone of my makeup, that was where I wanted to be.
And when you were trading with Mark on site in his office, wherever that might have been, is that something that you actually paid for, or did you just somehow be able to form a relationship with him and sort of get your foot in the door that way? How'd that opportunity come about? Because, people listening to this, they're like, you made a list of the best traders in the world, and then you sort of tried to reach out to some of them and, spend time with them. It's quite incredible that you were able to, get that time with Mark. So I'm just curious how that actually panned out.
Well, I've done both with Mark. He's a friend now. I actually nearly got him over here to Australia to come and do a conference, and he was ready to come, but the demand just didn't seem there, which surprised me. I mean, it's just such an opportunity to sit with them. But Mark, when I went over, it was for a pay program. I don't recall the exact cost, but it was between $5,000 and $10,000 or something like that. And then obviously, you can establish whatever relationship you want going forward from there. And there was a couple of us who did that, and it was for a week over there. And yeah, I think it's really worth doing. And you might not have to go to America to go and do it. I'm sure there's some good people here in Australia, but it is just formulating what his daily ritual was and seeing how he prepared every morning. And the same goes for Mark Minervini. He does a paid service, and last year went and traded with him. And, just the calmness that you see these guys in, it's a second nature to them. The alert either goes off or it doesn't. There's no stress. It's just that trade works. You're either right or you're wrong on it, and then you just repeat. But I mean, these guys are masters of what they've been doing. They've probably taken that trade tens of thousands of times. So it's just a repeat model.
So with Mark Minervini, what were some of the really big things that he taught you, or things that you picked up from him? I know it's kind of a bit of a cliche question, but was there anything that really sort of stands out as being sort of, that's the reason why he's a good trader?
Oh, Mark's, I mean, he's just a great trader. He's very mathematical, so he has his couple of setups which he uses. The VCP's a big one, and he'll take that and over and over again, just the same repetitive pattern. And then just how he scales in, scales out of positions, how he's always looking, to be a 2-to-1 trader. So that means he's got to be right half the time, and his average gain has to be twice his average loss. And I think once you work out that, you keep your scorecard, as he used to put it, where you record every trade, how long you're in the trade, what the results were, and you analyze that just religiously. Weekly, monthly, quarterly, you very quickly pick up where your faults are. So he, 4 or 5 years ago when I first went over to see him, just really drilled that in, and it helps, as I mentioned, it helps see your own weaknesses. So it's the deviations between making 0% return and 20% return are not that significant if your average loss moves from 10 to 7%. That can have just such a compounding effect. So I think that was a big one. And again, just the discipline. there's just, I don't want to speak for Mark at all, but I just can't imagine him taking a trade outside his system. Like, it just would not happen. So, and same with Mark Cook.
When you need to build up your team to handle the growing chaos at work, use Indeed Sponsored Jobs. It gives your job post the boost it needs to be seen and helps reach people with the right skills, certifications, and more. Spend less time searching and more time actually interviewing candidates who check all your boxes. Listeners of this show will get a $75 sponsored job credit at Indeed.com/podcast. That's Indeed.com/podcast. Terms and conditions apply. Need a hiring hero? This is a job for Indeed Sponsored Jobs.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
Something you said to me, again referring to a conversation we had prior to this call we're on right now, you said that probably around about 80% of mistakes that particularly newer traders make are avoidable. Why do you say this, and how are they avoidable?
Well, I guess the big mistakes for a momentum-based trader such as myself is you should be able to buy at the danger line, so at the point where the trade becomes active. So, I mean, if you limit your buy above that point to 3%, so let's say your alert goes off and immediately it's gone 3 or 4%. If you just don't take any over that bracket there, that'll reduce your chasing. And one of the big things which affected my trading, which really improved my numbers, was violation. So if you do buy it right, and the stock pulls in on you straight away, you'll have your stop loss in play. But what are the only times to get out before your stop loss is triggered? And I still see some guys I talk to a bit about trading, like you'll still see them buy perfectly. The stock pulls in 3 or 4%. They go, bugger it, it's not working. Close the position out, and 2 weeks later it's up 30%. So, I mean, that's just two ways of just right there of you've bought the thing right, but you're not A, chasing, and you're not B, choking the trade off too early. So you're giving it a chance to work. And so I think most people, as we've discussed already, who go into trading, they have style drift. So they'll, instead of focusing on say that particular setup, they'll be intraday trading the S&P or the Aussie dollar. So, if you don't chase, you stick to your setup, you trade one asset class, don't add to losing trades, and don't trade against trend. Right there, you've got a pretty good chance of surviving, and it just comes down to risk management. And I think, most people who've tried to go out or trade on their own, who haven't been mentored, have been told, this is a stock to buy, and they just keep buying it on the way down. And the effect of a stock that falls 50% has to go up 100%. Everyone sort of knows that old adage. So if you get yourself into trouble early, it's quite a big hole to dig yourself out of. So another thing I've found as well, moving back from cash, when you are forced to cash by the market, is just to come back incrementally. So, I talk to people and they'll say, oh, everything looks good again, we'll quickly go 100% long, and that's how you can have big drawdown happen. big drawdowns happen. So if I'm coming back in from cash and I'm seeing a couple of leading names set up and the index is still going sideways, and then I see a few more leading names set up, I'll try one or two out. And if they're not working, I'm not going to be adding any more positions. So I'll let the market tell me to be adding, rather than just having a view that things are fine now and I quickly need to get back into the market.
Okay, I actually really like that point. So you're talking about in periods where you might not have any trades on and you're entirely in cash and you start to see some names setting up, you don't just, put trades on every name that you see. You're just sort of slowly building your positions back up. Did I understand that correctly?
That's right. I mean, my system works very much on following leadership. So what are the leading sectors? What are the leading names in the sectors? What's driving the market internally? I couldn't care what the index is doing. If it's under high distribution, I'm not going to be in, and there's pretty high chance that there's very few names setting up constructively. So it doesn't happen. But if say, I remember the index last year looked like it was going to break out through 5.6 or 5.7, I forget, and all of a sudden we had a bunch of distribution set up in the pivot and the leading names started failing. So I went back to cash, and it was another sort of 6 weeks until we got a turn and the leading names set up while the index was still finding a bottom. Tried one or two out. You're up quickly in them, or they go sideways or they go down. If I get stopped out on those one or two names, well, the market's telling me that it's not ready to go, or that my criteria is faulty. And now I don't think that's the case. So it's the market telling me that it's not ready to move yet. And so you can keep, if you're taking a 10% position size, and let's say you've got a 10% stop, you lose on both those two trades, you drop 2%. It's not the end of the world. You can recover from that. But what you don't want to do is go 100% long, get stopped out of, everything pretty quickly and drop 10 or 15%.
Okay, so you're obviously talking about risking 1% of your capital on each trade.
That was just an example, but yes.
Yeah, okay. So now's probably a good point to actually talk some specifics about your actual strategy. So, just from a high level, how would you describe your style of trading?
I'm not actually sure. I guess it's a momentum-based trading approach where I look for strong sectors, strong company stories, strong earnings, strong revenue growth, and then I will always use a chart to get in. And I only have a couple of entry points. I have the volatility contraction pattern, which is from Mark Minervini. So if anyone's interested in that, you can buy his book and read about it. He goes in depth about that, and that's effectively a breakout trade. And then I use a pocket pivot, which comes from Gil Morales and Chris Catcher, and then sort of a pullback buy method where the stock is already trending. I've already initiated a position from a breakout, and I'm buying off the first pullback to the moving average when it's obeyed on the uptick. So I wait for the higher close of the previous bar. And really, I mean, well, on the long side anyway, that's about it that I have. And there's just no shortage of trades to find. So it's never a problem that am I not getting enough stuff setting up. There's always stuff setting up when I should be in the market. If there's nothing setting up, well, that's the market telling me something. So by sticking to this process, you automatically eliminate those times when you shouldn't be in the market, when you should just be sitting on your hands or short if you like to short stocks and can do it properly.
Okay, and we've already established that you're not a day trader, so you probably fit more into the category of what we'd call a swing trader?
Yes, yeah.
Okay, and what markets are you trading? Just the Australian markets?
I trade the US as well. I did trade the US primarily for a few years, but you kind of get a bit worn out doing that now. Just because of the time zone difference. So I trade the Australian markets, and I'll run through my US stocks tonight. And as I said, I chat with Mark Minervini and with Gil and stuff over there. So, if they're looking at something decent or posting something decent on one of their sites, I'll have a look, and if I need to put an order on, I will. But probably 90% of my stuff will be in Australia these days.
Okay. And tell us a little bit about how you scan, how you actually go about finding potential trading opportunities, like stocks that are setting up in accordance with your criteria.
Well, you can write code in basically any charting package these days. So I have probably 15 different scans, and I use 4 religiously, and I'll just be looking for basically inflection points. So for a pocket pivot, there is just set criteria. It's you're looking at a 10-day back period for volume. You've got to have higher volume than any down day, and the stock needs to come from below the 10-day moving average, close above it on that volume. So you can write code to find that. The VCP, a little bit harder to write code, but you're basically looking for a pivot. So you're looking for tightness in price and contraction in volume, as well as a contraction in the pattern. So I try to write my code relatively loosely, and then I go through 4,000 or 5,000 charts a day, and a lot of them are the same chart. So I'll do at the end of the day, I'll run all my scans, build watch lists based on how they're setting up, the duration of the base. So I might have 4 active lists, which would move from, potentially buyable in the next 2 weeks to this list will probably go today. And then I'm just adding and subtracting names from those lists. And it's still, there's no easy way in the stock market that I've found. The scans certainly have helped improve. I mean, those old guys that had to go through them by hand or draw the charts, that's real work. But it's just repetition going through. You build your chart eye up. All of a sudden, you just see that pattern that, based on your scorecard is a good pattern to take. And so that's what I do. So I do that every night. Then I'll go through them in the morning with a fresh eye again, see if I've missed something, and then put my alerts on, and then, sit down at the desk and watch a documentary and wait for the alerts.
Okay, so just so I understood that correctly, you're not manually looking through 4,000 to 5,000 charts. That's how many sort of tickers you're feeding into your scans. Is that right?
I'm manually going through them. So you can scroll. I've talked to people about this, and they didn't actually know this existed, which I find crazy. But just the scroll button on your mouse, I can scroll through 50 charts in probably a minute and a half. So I'll just have them set up on the daily time frame and the weekly. I'll have 50 on each list because that's the max the list can provide from the software, and I'll just scroll down those 50, and it only takes 1-2 seconds to look at a chart to know if it interests me. And so most don't. So, and then it's just going through maybe them again in a day a couple of times. But yeah, so it is still a manual process. And then with the fundamental filter, there's better software in the US. The Australian market doesn't quite have the Market Smith platform or the HGSI platform where you can sort of scan for certain earnings and earnings increases and return on equity and cash levels and all that. So we just wrote something in Excel which pulls data from a provider there, and that'll help identify to us what sectors may be having the highest revenue lift, or what companies are having the biggest quarterly increases in earnings or revenue. And as I said, then run them over, put them through the charts, and if they're not ready, they're not ready. If they are, they go to one of the watch lists.
Okay, so are you using Excel only, or are you using an actual software charting package too?
Excel's just to pull the fundamental numbers. The charting packages, I know TradeStation are a sponsor with you. So we have TradeStation, I've got CQG, I've got Pro Real Time, I've got a few. So you can write, it doesn't matter what system you write it in, they're sort of, they're all the same. And then you just scan for them, and it'll pop up a list, and you just got to click through them.
So if we were to look at your chart, if we were sitting in your computer chair right now, looking at your screens, what sort of technical and indicators and technical analysis would we see on your charts?
I'm just really a price and volume person, and so I don't really look at RSI or MACD. I do have an MACD just for my intraday when I'm moving into a position, but for me, really, all I need is price and volume and moving averages. And I use the moving averages as reference points where a stock should be accumulated from, where the base or where the price in the base is sitting. Is it sitting on top of a moving average? Is the price chopping down through the moving average? Because when a stock's trending, institutions will be buying it, so they'll normally be holding a certain price point, whether that be the 20-day EMA or if it's trending hard, the 10-day. And that also gives you a reference point to trail a stop, or if you think that immediate term trend has shifted or changed. So yeah, it's pretty simple what I do. It's volume analysis and price analysis and base analysis.
Okay, so once you've identified a name which you see as a trading opportunity, what actually serves as your confirmation signal to get into a position?
So I'm normally using a pivot point. So most setups that I'll buy will have a contraction through the range. So if you think about it like a cup shape, like what you'd see on a cup and handle, I really want to see at least 2 cups, if not 3 or 4, with each cup getting smaller as it moves to the right of the chart. And through there, I want to see the range of price also contract. So it should just look like 3 little mini cups coming into each other, because that's telling me that the supply is diminishing. So there's not so many people willing to sell their stock at that. So the weak hands are being weeded out. I'm only buying uptrending stocks, so you're going to have less of likelihood of that really bad news result. I'm not buying stocks that have ever had a gap down in the price. I just stay away from them. And then finally, when the stock is setting up, for me, it should have a big dry up in volume, and the price ideally just goes super tight for a couple of days. And that might only be one day. It could be 3 or 4 days. And then I'll just set my alert above that little pivot point. And when that goes through there, I'm buying.
So you set an alert and then you put an order in once you obviously check it out and see if that's something you want to be in. You don't actually have orders waiting in the market to catch that?
It depends on the stock. A lot of the smaller stuff in Australia, it's too risky with the spread. And a bigger stock, obviously, no problem. But no, I generally manually put it in. I still have that discretionary opinion where I'll look and go, right, yep, that's ready to go, that's not. And so, the negative of that, I guess, is if you get multiple signals at a time, but I mean, that very, very rarely happens. So my computer will just start beeping at me, and that's time for me to, to start pressing a few buttons.
Right. Now, I might just mention, it might be helpful for those who are listening and actually want to visualize some of these things that we're discussing here. So you post a lot of these setups and a lot of charts on Twitter. So I was going to suggest if you want to actually see what this looks like, sort of struggling a little bit to visualize it in your head, check out your Twitter feed. What's your Twitter handle?
It's at Rolly, ROLLY Trader.
Okay, excellent. At Rolly Trader. Now, just still on the point about entries, what happens if you miss your ideal entry point?
As we discussed before, that's something that'll be in my trading plan, which is another thing I think you have to have. So it's basically a rule book for your trades. And it was something that Mark Cook just drummed into your head. If you don't have one, you won't survive. And I think it's very true. So for me, if it goes 4% past there, it's off the table. I just won't take it. So it's as simple as that. And often you'll get a pullback, what I would call a pullback buy, where the stock breaks out and then it'll pull back and to retest that breakout level. And so I'll keep it on the watch list and, be ready to buy it potentially off another setup that happens during its run. But, I'm not going to chase anything.
Okay. So if prices moved more than 4% beyond your actual ideal entry point, you leave it. If it comes back into that zone and retests the breakout point, then you may consider taking an entry then.
Yeah. If what I want to see is I don't want to ever buy on weakness. So if it comes back in and tests that breakout point, I'm waiting for the next day for the close or for the intraday to be above that previous day's high.
Got it. Okay. Now, how do you determine your risk and your position size for each trade that you put on?
Well, there's a formula called optimal F, and if you put in your trading stats, that'll tell you the optimal position size you should be taking based off your performance. But for me, generally, broadly speaking, I don't like to trade more than 8% in a position, and that's on the initial position. If I'm in a name that goes up quickly, obviously that will increase your exposure just through its return. But I will go up to 20% into one stock if I get multiple setups in there. But just how the market's been the last couple of years, it's been very choppy. It hasn't paid to pyramid your positions. It has been more of a swing traders market. So that's pushed me back. When there was some stuff trending in 2010 and 11, 12, my approach was slightly different. And you've just got to adapt with the market. I mean, you have your trading rules, but they have to be adapted because the market's dynamic. And it's not the same. It changes all the time, but, yet the character remains the same. So you can operate with similar setups and similar criteria, but there's right and wrong times to implement those criteria.
Okay. And I just want to clarify something. When you said that, when you mentioned 20%, that doesn't actually mean that you're risking 20% of your capital, does it?
Oh, no, God, no. Well, I guess effectively you are if it announced something and went to zero. But no, my average stock will be what is about 6.5%. So, if let's just call it 10% to make it easy. So if you're taking a 10% position size, your risk with a 10% stop is 1% of your total capital. And I think that's a good place to start. You probably want to be between 0.5% and 2%, depending on your experience and your trading style. But if you go too much smaller, it's hard to make those big gains. And if you go bigger, you're asking for trouble because you're going to have that occasional stock that gaps down on you, and you're of course going to have a lot of losing stocks. So controlling risk is the number one factor, I think, in a successful trader. Anyone can work out how to buy a VCP or a pocket pivot or anything like that, but if you don't control the risk and don't know how to incrementally scale in and scale out of the market, you're going to deal with big drawdowns.
Yeah. Now you mentioned, or you brought up optimal F as a formula for having sort of optimal position sizing.
Yeah.
Where can we find out more info about that? What is optimal F? I've never heard of that.
I'd just say Google. I use one through Mark Minavini's site, where he has a calculator on there. And so if you put in that your average gain is 15%, your average loss is 7%, and your win-loss ratio is 50%, and your target is to make a 50% return this year, it'll say, well, you'll probably need to do 80 trades at 11% position size or whatever it is. So that's just a formula. But I mean, you probably don't need to get as complicated as that. I think, the general rule of thumb is probably 5 to 10% for most people that you see on what position size as a percentage of their portfolio they should take, and then your risk obviously depends on what nature of stock you're trading. A lot of people in Australia trade the really micro cap names, and they award good returns, but the spread on them can be 10% alone. So it's hard to be a real risk manager when the bid and ask can stop you out. And I think that's another pitfall of new traders, is to go into those penny stocks. You're better to trade the leading names and develop your skills, trading them, trading the Domino's pizzas or the mid-cap leading names, the aristocrats, and you're not going to get the big moves. Well, Domino's probably proves me wrong there, but you're not going to get them so quickly. And I think a lot of people like that gambling feel where they go into a 1 cent stock and it goes up to 2 cents, and they think they've done something right.
Yeah. So just going to the other end of the trade now, how do you determine your exit points?
Selling's very, very hard, and something I'm certainly work in progress. But for me, again, your average gain will dictate a lot. What that your scorecard says that you make, and also a multiple of risk. So if I'm risking, call it 1N, and which might be 5%, and all of a sudden I make 20%, I'll definitely be selling partial into that. And then it depends on how quickly it moves. If it moves up 20%, and then in 2 or 3 days, I'll probably sell a big portion of that into it. If it's a nice orderly chart and slowly drifting up, I'm probably adding to it. And then finally, to get out, I'll use a moving average. So that will depend on the trend of the name I've bought. If it's holding the 20-day on the first test, and then it breaks down through it on its second test, that's when I'll get out.
Okay. So it's fair to say that your exits involve quite a bit of discretion.
Yeah, they do. It depends. It depends on the nature of the market. I mean, a name, for example, that I've been tweeting a bit lately, that IIL and CIA, that was a power play setup, which is a particular setup where the stock moves 100% in less than 8 weeks, and then has a base less than 25%, and then resets up a base. So most people think it's way too extended, but it's actually quite a good probability trade. So we're buying that CIA at 50 cents, and it just ran straight to $1 in probably the last week. So I was actually selling a bit today, and I sold a bit 2 days ago, and there's sort of no rules there. It had 3 gap ups in a row, and it's just moved so hard, and so I'm just going to bag some and let the rest ride. Ideally, I want to move my stop to break even as soon as possible. So if I'm up 10% in a trade, I'll just try to reduce my risk immediately. So bring the stop up. If it moves up 15, 20, I might sell 25% of. If it forms a new base, I'll just add back. I'll buy more. So again, it's just incremental selling, incremental buying, reducing risk where I can.
Well, sounds like a good trade to be in. Well done. Now, you said a little earlier, or you hinted that most of your trades are on the long side. I'm interested to hear the reason for this. Why do you prefer trading the long side and rarely trade the short side?
There's been a few occasions I've been on the short side in the last sort of 3 or 4 years, but I mean, we're in a bull market. Well, certainly in the US. The Australian market, there was a great trade, short resources, until probably a year ago, a year and a half ago maybe. I'm not as good at shorting stocks, so purely my scorecard tells me that, so I'm not going to focus on it. If the market comes under distribution and I'm forced back to cash, again, by keeping a leading names watch list, the best names to short are the former leaders. They're the ones that will break down the hardest because they're the ones that have the most froth in them. So if I'm looking through the list there and they're all looking like they're going to, continue falling, I'll move in on the short side. But it's not something I want to be doing. I don't have any short positions on at the moment. It's not something when the market's giving on the long side that I want to be doing, just purely for a state of mind thing, and purely because the reward for me is not there. And I'm not one who hedges out my portfolio. I mean, very rarely will I do that. Maybe if there's a big event coming, I might, use a few options or take an index position, but that would be once or twice a year.
Okay, so really what you're trying to do here is just focus on your strengths, ignore your weaknesses.
Well, I'm working on the weaknesses, but I'm working more on what makes me money. There's no point trading something that's not going to make me as much money, even if I'm better at trading it. The market, especially the US, it's a strong uptrend. So I don't think you need to be on the short side unless you're probably a shorter term trader than I am. And absolutely, nothing wrong with trading short, and those people are good at it. It's great, but it's just not one of my strengths. So it's not something I avoid, but it's something that just doesn't happen as a large percentage of my trades.
Yeah, makes sense. Now, stepping aside from trading, something which you have done, which I'd like to ask you a few questions about, is you've actually taken some of your trading profits and you've put them into venture capital. What attracted you to venture capital?
I've always liked, I guess, how business operates and being involved in small businesses. I've got a few friends that have, been pretty successful as entrepreneurs, and I guess when I was an analyst and working on in the different side of the market, you'd meet so many company management spokesmen for the company, and you'd hear their stories, and some of them, were great stories. Some of them you could quickly identify probably weren't going to amount to too much, but it always intrigued me to see how the business actually works under the hood. And just, I guess, by chance, I got into the first one and brought a couple of other people in, and it was a friend developing a business, and he was asking for some advice, and I said, do you need, some capital? And he did, and that business is ticking along. We're sort of up to 80 staff now, and two of them I've started myself, and the others, again, are just opportunities which I've seen, which all of the ones we look at have an idea to IPO, or, well, ideally to IPO, but they're products which potentially have that appeal and have that exponential growth. So like any startup, they will require capital, and some will fail, some will succeed. So similar to the market, it's just trying to identify the good ones and stick with them, because you're going to get your bad ones. There's no doubt about that. So we've got 5 businesses now under there, and they're all alive at the moment. Maybe next year I can report in and tell you how they're going.
Yeah. Well, are there certain types of businesses which you prefer to invest in?
Well, certainly what we have invested in has been, they're all very different. One's property, one's equipment hire, one's a stock market, one's fashion, and one's in agriculture. And so all pretty different industries, but they're all connecting people. So I guess they're all this new world technology. Either one's AI, one's just aggregating all the suppliers and tenderer options. So it's just, I guess they're just all trying to make it easier for company management to operate. So we're trying to find them a solution at either no cost to them or very little cost to them, and then something they can roll out through their businesses. And it certainly seems to be the new way forward, is especially with AI and how it's starting to now come in. Is 10 years ago people thought Webjet was an out there, or 5 years ago, whatever it was an out there process, and having one website which shows you all the flights and where they can go. And I mean, in a few years' time, it's just going to be a chat bot or a personal assistant on your phone, which you tell, and they go and source that data for you. So maybe we're just building products for the lazy man, but we'll see.
So is that intentional that each one of these businesses is in a totally separate industry, or is it just kind of worked out that way?
No, it's probably more just worked out that way, I think. But I think probably in the small business world, you're either very specialised and have a big company, or especially in the more venture capital model, you're probably a little bit more diversified.
Right. And have you noticed any big similarities between trading and venture capital?
Well, I mean, it's all just risk reward. So I guess that's a very obvious one. The liquidity of the stock market is just it's a gift. People probably don't appreciate it enough. The ease, especially if you're a small account, if you're under $3 or $5 million, just your ability to come into a position and out of a position in minutes is just huge. You can, as we've discussed, just move back to cash, take some time off. You can regather your thoughts, and in the private business world, you're stuck there, and most of businesses require multiple capital injections. So, you've really got to make it work, and there's more often than not never a liquidity event. So there's certainly different mindsets that you need, and we've got good managers who run all the businesses. So that's, they take on that burden more than I do.
Yeah, and that's a very good point. I mean, I recently sold a property, and I remember saying to my girlfriend, I was just like, the process you've got to go through to sell real estate is ridiculous. Like if I wanted to sell, a few $100,000 worth of stock, I could literally do it within a minute.
Exactly.
In real estate, that whole process drags out like 3 months pretty easily. So I think that liquidity of trading is of huge appeal. Now, you said earlier that you have plans, or it's kind of in the future to IPO some of these companies. That would be the ideal situation. What's the process involved in actually getting to an IPO, and what's the incentive of doing so, of going from a private company to a public company?
The process, we've got one now, I guess you would call it in the process. So you meet a few brokers or corporate advisors, and they either like and believe in the story or they don't. And assuming they do, you might do a pre-IPO, which for the transition from a private to public business involves quite a lot in terms of compliance. So you might need X amount of new heads come in. So you might do a pre-IPO to be able to fund that, and get all your, everything audited and get everything looking correctly. And then you move through it. It takes about a year if you're doing the pre-IPO or 9 months. And the benefit, I guess, is access to capital, especially with companies that have a lot of potential but require a lot of money to get there. There's only so much help that the founding shareholders can do, and we've had a few external capital raisings for the different companies, and it's a very hard, long process. We were probably a year doing a raise for one of the businesses, and it really took the MDs a lot of their time. And great, we got it away. I mean, it's fantastic, and the company's growing quickly. So I guess a liquidity event for shareholders, the chance for new shareholders to come in who believe in the story, and the access to capital to grow the business. So I guess that those are the defining features.
Yeah, no, that's good. And so how does a pre-IPO work?
Well, you might just go to whatever broker it is, and you might say we want to raise 4 or 5 million on the IPO, and we might need $500,000 or $1 million, 6 months before, in order to employ maybe a professional chairman or a director who's got a name in the industry, do your compliance, tidy up a few things. So it's really just a little bit of teething money so you're ready to hit the market properly, because there are those additional regulations and the cost of actually IPOing and doing all that. So, if your business is flush with cash, you might not do a pre-IPO. But if you need a bit of tidy up money or expansion capital, that's something you'd do. And normally that might be sort of a 6-month window until the IPO, and those people who come in at that level are normally given the shares, or they purchase the shares at a discount to what the IPO will be, and that might be 10 to 20, 25% for taking on that additional risk.
Right. Okay. Cool, man. Well, let's leave it at that. Where can listeners go to find out a bit more about you? Is there anything you want to share? Is there anything you're working on? Give us the lowdown.
Well, one of the new companies I've been building, it's called SUBE, SUUBEE, and what we're trying to make is a new way to access financial information for stock traders in Australia. So I'll be providing every trade I do through there. There'll be lots of traders that I'm sure some of your listeners follow on Twitter who'll be doing that. We'll be having trader meetups, discussions, really just trying to build a new platform to help educate and train people and for traders to watch someone trade and learn their style and eventually be able to mimic it. So we've been building that for the last 2 years, and we're in beta at the moment. So we're hopefully we'll be launching later on in the year. But there's a web page up just for expressions of interest. So if anyone wants to really see what I'm doing, I'll be doing everything through there by the time we open. Otherwise, I'm just on Twitter.
Okay, and do you just want to share your Twitter handle one more time?
So it was at Rolly Trader.
Okay, and that's ROLLY Trader.
That's right.
Excellent. Well, thank you very much for coming on. It's been really great speaking with you, and thanks a lot for agreeing to do this.
Thank you very much, Aaron, for including me, and look forward to having a chat soon.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Hey, it's Ryan Reynolds here from Mint Mobile. Now, I was looking for fun ways to tell you that Mint's offer of unlimited premium wireless for $15 a month is back. So I thought it would be fun if we made $15 bills. But it turns out that's very illegal. So there goes my big idea for the commercial. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3 months, $90 for 6 months, or $180 for 12-month plan required. $15 per month equivalent. Taxes and fees extra. Initial plan term only. Greater than 50 gigabytes may slow when network is busy. See terms.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
This episode is brought to you by Accenture.
When your advertising operations fall out of sync, everything else follows. Spotify and Accenture are working together to reinvent the rhythm of ad sales, using automation, analytics, and smarter workflows to simplify campaign delivery and access better data across the business. The result? Less time spent on operations, more time connecting brands with the moments and fandoms that matter most. Learn more at accenture.com/Spotify.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, crew? Welcome back. Welcome to episode 111. This week, returning to Chat with Traders for a second time is David Bush, who was first on episode 23. David first began as a discretionary trader more than 20 years ago, but over time he's developed into almost purely a quant trader, and he's exceptionally good at what he does. David's been the first place winner of 2 real money trading competitions in recent years. Last time David was on, we spoke fairly extensively about his path as a trader and a high-level overview of his process. This time around, we covered plenty of new ground, exploring David's process in greater depth. Also, I particularly liked David's comments towards the end about intensity, not time. That'll probably make more sense when you get to it. But anyway, full show notes for this episode can be found at chatwithtraders.com/111. And I really hope you can gain something from this. Please welcome to the podcast, David Bush. Hey, Dave. How's it going, man?
Good. How are you doing today?
I am doing very well. You're a bit under the weather, are you?
I am. Yeah, it's been a stretch, man. It's been a stretch, just busy and pushing it. So under the weather, but, I sound horrible, but otherwise I'm all right.
No, you don't sound too bad.
All right, good.
What is it? Just a basic cold?
Yeah, it's a basic cold. Yeah, I normally avoid it, or it's very light. This year or this winter, I've been sick twice like this in the last 3 weeks. So it's just, this one was self-induced, I think, from just trying to fit this R workshop in at the end of the week. I mean, I'm glad I have that knowledge now, but I'm paying for it, you know what I mean? Because I had to fit everything around it. And you were caught in my whirlpool of rescheduling. And anyways, so self-induced problem.
You've got me interviewing you at 7 a.m. on a Sunday morning.
Well, you're the man. I'm so sorry. I was about to ask, and then because I didn't do the calculation in my head, but wow.
No, not a worry. Not a worry.
I appreciate it.
No place I'd rather be.
Have you ever seen this time of day before on a Sunday morning? Or
Of course. I'm usually up well before this anyway, so I'm just teasing.
All right, good. Excellent.
So how was the workshop? How was that?
Yeah, it was, it was an introduction, but it was 2 days of an introduction, so two very full days. There's two ways I look at it. There's my goal, which is, first of all, just to learn about R. I really knew not a lot. And then, other than, statistics focused and whatever. But my goal is really just to be a better manipulator of data. I mean, we might have talked about this the other day briefly, but, just have my data set up in a much more, usable, automated, updating way. And then to be able to actually hands-on just more quickly, manipulate it. So basically, I feel like I right now have the skills. I mean, I'd be very slow at first, but that's how I'm going to cut my teeth. I have the skills to, just import and join a ton of Excel files. And it's, it's so quick, in R. It's just like, it's instant, and you can hyper-thread if you want and all that stuff. So that's, I feel like, great, mission accomplished. I'm going to, I need to sit down and spend hours doing it, but if I can just become awesome at mutating and joining Excel files, that'd be great. And then I got to peek into the other levels, which are like, well, you can do anything, you know what I mean? Just like most code, you can do insane machine learning. You can use it for graphic portfolio analytics, whatever, and obviously there's a lot of packages that people have already created, which is cool. So I got to avoid the temptation to go deep into the weeds, like, trying to solve the world's problems through R and just like have that one skill, So I thought it was great.
Oh, that's excellent, man. That's very good.
Yeah.
So you hadn't coded in R previously before this, like at all?
No, exactly. No, I've never, I didn't have R installed until, like 24 hours before the thing. So no, didn't know R. And, but I feel, like that data manipulation thing, I feel like, I know I'm going to run into walls. I mean, you always do when you're coding, anything, it's always longest at the front, which makes it tough to go through, through the barriers. But we did in class, it was a very hands-on thing, basically the guy would talk for like 5 or 10 minutes and then he'd be like, all right, here's what you're going to do now, and that's the way the whole 2 days was, which was good, so I already succeeded at doing probably 75% of what I want to do anyways. Now it's just getting good at it and, setting up some scripts and...
Yeah, just putting in the work.
Yeah, I'm excited.
Yeah, man. Oh, excellent. So I know you've got a programmer who you work with.
Yeah.
Prior to this, did you have any programming knowledge yourself? Like, were you coding in a different language beforehand?
Well, what I've done, I always think of it like he's a capital P programmer. I mean, like he's trained, that's his whole schooling, that's his PhD. He knows probably tons of languages and is facile in most, For me, I started coding in just proprietary trading platform languages like TradeStation's, Easy Language, or Mechanica's language, what else? Trading blocks, so in other words, they're all just kind of proprietary trading specific languages. A pure language, something I have not ever learned. I mean, I have some Python scripts and so forth, and some utilities that use Python, but that's because the PhD programmer wrote them for me. So I'm excited. I mean, actually, that's another level of just, learning R and be able to do things. Obviously, it's much easier to grasp this language, having known the language of other platforms and syntax and stuff like that. So it becomes, it felt like familiar, actually, which was kind of nice, right? I mean, there's a first language that's just purely its own thing, with many applications, not trading specific, and yet, it felt familiar. So it's pretty cool.
Yeah, absolutely. And I think R is quite similar to Python in many ways. So if you've seen a few Python scripts previously, then I'm sure, you could probably interpret R reasonably well, like sort of on a basic level, I'd presume.
Interesting. Yeah, I was a little disturbed when somebody asked a question that was in my head. I mean, I just wanted to ask it, but I wasn't going to ask in front of the class and waste everyone's time. But, one guy was really pretty good. He was picking up everything quickly. He obviously had a lot of programming knowledge already. And, he at the very end, he's just like, so what's the difference between Python and R, in your opinion? And the instructor was like, I don't really know. I don't know Python. So, okay. I was like, really? It's like, are you just so uninquisitive? Because I was wondering.
Yeah, but, no, many similarities, I think. So what was your preference to learn R? Like, why did you decide to pick R?
If this Business Analytics Center, University of Cincinnati, if it had offered Intro to Python 2-day workshop, I would have done that. You know what I mean? They just did Intro to R for whatever reason. So that was it. Either one I would have gone to. It wasn't like I sought out R. I knew that I'd get a really quality experience because I've took a 2-day Tableau, data viz workshop. So
now, also in other news, since we last spoke, I think that was episode 23. I meant to check before we actually got on the call, but it was early 20s anyway. So for anyone listening, if you want to go back, check it out. Early 20s when David Bush was first on the podcast. I was speaking to you not long after you'd just won, I think it was Battlefin, if I'm getting that correct.
Correct, right.
Now, correct me if I'm wrong, but you've also won another quant trading competition since then. Is that right?
It is right. Yes. And I'm trying to think now. Yeah, thank you. I appreciate that. Yeah, it was first place in this NAME, which is an acronym, National Association of Active Investment Managers. They had a strategy competition. So actually, I trying to think whether it was purely a systematic or quantitative contest. I actually think it was not, but certainly that was certainly the focus of those who were presenting. And that was a great. It's a great group. Great organization, great, very welcoming people, and the competitors actually were very impressive. I was certainly pleased to win, but happy to meet the other guys.
So, how many other people were you up against? I remember Battlefin was something like between 2,000 to 3,000 people.
That was a lot of people. Yeah, they had tons of applicants, and then it got narrowed down into 3 groups of maybe 9 competing over a few months, something like that, and it involved the presentation in Manhattan as well. This was quite different. And I don't know how many applicants there were, but there were a couple series of presentations, and the first presentation was in the fall of maybe 2015, I think, and that was maybe 15 to 20 people. It might have been 16, rings a bell, so I'm not exactly sure. And then that got narrowed down to maybe 6, if I'm remembering correctly. And then the 6 or so of us presented in the spring of last year. And it was an interesting group. I mean, you had individual, traders with a strategy they had created. You had small money management firms with proprietary strategies, a group of strategies. You had, I think, 2 actively managed mutual funds, which alone, it's funny because on one hand, some traders say, mutual funds, what good is a mutual fund? I'm going to trade the market in my self-directed way, so on and so forth. But to actually launch and, take a active strategy, put it in the mutual fund wrapper and get that out to market and make that a viable reality is actually quite challenging. So, I was impressed with all of them, bottom line.
Right. And during the competition, was it all trading real money?
That's a good question. My strategy is real money. It has a model, but it's approaching 6-year anniversary of real money trading in March of this year now. In terms of the other strategies, obviously the mutual funds, real money naturally, and millions of dollars, and then there were a couple other strategies. I'd say predominantly there might have been one that wasn't. I think that was something like that.
Okay. So the strategy that you traded during the competition was the same strategy that you've been trading for the past, like you said, 6 years.
That's correct. Yeah, it's an equity strategy. So it's blue chip stocks, mega cap equities, and that's been live since 2011 in the spring, or late winter, spring, March 2011.
Right. Very interesting. I always thought that, I don't know why I thought this, but like a lot of traders who enter into these competitions were trading like purpose-built strategies to try and win that particular competition, but obviously not the case.
Well, it's interesting. I think you're spot on that there are these competitions that are exactly that, where they're essentially orienting the whole investment approach or trading approach to winning. Drawdown be damned, whatever long-term efficacy, who cares? Just win the competition. But these competitions, it's funny because I never set out to be a competition winner. I'm thrilled to be one a couple times now, but really. These just kind of fell in my lap in the sense that I learned about them by one means or another and decided to enter, usually at the last minute, often right at the deadline, I think, maybe in each case. And, why not? This could be interesting. And, they were not that kind of competition. They were really about the whole picture, so to the credit of each of these groups, Battlefin and Name, their competitions were rounded in the sense that there's a presentation you had to defend. You had to defend your returns and risk and your thinking, your model. You had to defend all of that and much more. And of course, had to have, good returns, or I suppose for those who didn't have real money returns, had to really defend their hypothetical models. But it wasn't about gaming and competition and just winning. It was really about the strategy and the integrity of the strategy. So maybe that's a bit different in the competition world.
Yeah. No, I think that sounds much better. It's much more realistic is probably one way to describe it. So, you know how you said you had to defend your strategy? Was there a panel of judges that you presented to, and did they ask you any questions?
Oh yeah, yes, yeah. Both cases, there was a panel. So in the in the first competition, the Battlefin competition, which I'm sure has evolved. I don't know how it's done right now, but at that time it was go into a Wall Street shop, and there's a meeting room, and you walk in and put your slides up, and you're on the hot seat, and you're just going to get, make a little presentation, and then you're going to get grilled. And it was similar for Name, although it was a bit more formalized. There was a whole, 100, 200, or however many people were there in the, in the room, in the theater, whatever. And then there was a panel of maybe 4 or 5 judges, something like that. And people I've come to know actually since, and some sharp people for sure, and very probing questions. Really just how. And I'll tell you, here's my takeaway from watching others. In one case, I got to watch others present. In the other case, I did not, but where I got to watch other, strategy creators, traders, managers, whoever they were, present and defend their strategies, really where people would fall from a great height. Maybe they've been doing great up to that point. It was always related to risk. Every single time they would just unwrap, because if the panel would start to peel that onion around how they thought about risk, and this kind of risk and that kind of risk, and maybe sector risk and market risk and correlation risk, and on and on and on, you start to peel back that onion, and some of these very sharp guys either just weren't as prepared as they could have been, because they probably have answers, but they didn't articulate them well, which, didn't work in their favor, or in some cases may have been a little light on the risk defense and the risk knowledge, and really having thought through every facet of that diamond. So that's something that I think about a lot. Is I think that did help me, because I've thought a lot about that, and certainly that was part of my development process. Made my development process longer, actually, for that strategy, because I was constantly looking at another facet of the diamond, to use that same analogy.
Yeah, that's really interesting, actually. That's very cool to hear. I've made a note here to ask you a bit more about risk controls as we get going, but yeah, I'm definitely going to pick back up on that. So last time when you were on, Dave, we spoke mostly about your path from starting out as a discretionary trader to becoming a quantitative trader. Now, this time I think we're going to pick up on a few of those topics and go a little deeper, as well as cover some new ground. So one of the first things I'd really like to talk to you about, or ask you about, is things around strategy development. So starting out right at the very beginning, when you come to develop a new strategy, do you have any predetermined metrics for what will be a good strategy in your mind, like goals or objectives, before even trying to find something?
Right, great question. And that's something if I could go back, I'm perfectly happy with my strategy, but there are times where I've thought, I wish I could go back and maybe rethink, rethink a couple aspects of the strategy. Obviously with a lot of perspective, having managed it now for almost 6 years. Again, mostly I'm very happy, but you do learn, you do gain a perspective on, what a great objective function might be, and many other metrics, which I can get into. Basically, one thing that I think that a new programmer, a new developer, and I've certainly talked to a number of people aspiring to either make that transition from discretionary to systematic, or simply finally deepen their knowledge of quantification and develop a model and so on. There's some questions I think that those people should ask is, first of all, who's the model for? Is this for pure personal or personal entity or family trading, for example, or is this for other people's money? That's a huge question right away, and one that really should be answered, because if it is for other people's money, then one has to be thinking about just a broad regime of questions, from regulations to, that can inform what asset classes one might choose to model. And that's usually not a question, because most people have, some, leaning towards, Forex or, futures or stocks or whatever it is. But, from regulations to, drawdown tolerance, your personal drawdown tolerance might have a much greater threshold for drawdown than a client, for example, for those people who are managing other people's money. So, that's one consideration. Very specifically, having an objective function. This is kind of the other extreme of now just the strategy itself. How are you going to determine your end result? Let's say you've gone through, towards the end of the development process, and you're choosing between a couple different sizing methodologies, or you're stepping across your parameter stepping various sizing approaches and finding where what sizing of your portfolio of systems, for example, is optimal for you. Well, how do you do that? That can be a number. One can develop a specific objective function. A formula is all that is. A simple formula that's just scores essentially all of these results from various sizing approaches, and therefore is rankable according to your objective. So, for instance, to make it a bit more specific, if one is looking for an annualized return that is some multiple of the max drawdown across all years of the backtest, for example, that's a number that every strategy run is going to have. And that formula could be part of an objective function with maybe two other similar metrics, right? And it all gets rolled into one formula. It outputs one number. That's then your objective function. That's what you're trying to maximize. And of course, you're trying to maximizing it without burning up the past. That's a whole other issue, burning up your data, finding a clever way through the past instead of a robust set of rules and a strategy that can generalize well walking forward into the future. Obviously, that's the real objective. But just in terms of your question, and hopefully I'm answering it at least in part, you can have an objective function that actually is a metric, and it's a formula that can be pretty simple, usually made up of a few different metrics, and essentially it's a score, and you can score your end results.
Okay, so in your response there, you gave an example about a metric of drawdown compared to return, something along those lines. Let's say you also had a couple other metrics that you wanted to achieve from a strategy. So let's say going into this, I want to achieve a Sharpe ratio of 1 or greater, max drawdown of 20%, something like that. How much would you be willing to vary on these metrics?
So how much would I'd be willing to vary in terms of, well, I have this great output here that I feel great about, but it has a really crummy Sharpe, and I wanted a higher Sharpe. Is that?
Yeah.
Exactly. Okay.
Yeah.
Right. That's a really interesting question. And these are, very great questions, and not always ones that I was thinking about. My number one, my objective function was essentially pretty simple. It was pretty much what I articulated, along with a couple of other things, which essentially was, positive in all years, minimal drawdowns, and an average annualized return that was a multiple of the worst drawdown figure. Average drawdown is not really something you should look at, in my opinion. Perhaps there's a case where that is important, but max drawdown and related drawdowns that were close, those are what you're going to be living through in the future, and you're probably going to be living through worse. Your worst drawdown is always going to come in the future. So that was part of my objective function. In terms of other factors, other metrics that maybe it didn't live up to as well. I didn't experience that, but I didn't set out with a smorgasbord of requirements. I really set out to do what I said, which is, without having full exposure to the market, to be able to stock market, in this case, benchmark being S&P 500 total return index, including the dividends and so forth. With that as a benchmark, obviously I don't want to be, well, maybe not obviously, but I don't want to be fully exposed to that all the time. Some correlation is okay in my approach. Other approaches are, non-correlated, and they strive for no correlation. That's a different, whole approach and discussion. But I didn't have a big list of requirements. So I think it's a discovery process, though. In other words, one should lead, one's development. There's going to be discoveries along the way that are probably going to be surprising. And especially if you're coding a cherished notion like, every time this makes a 30-day high, this market and, this other factor and this other factor are happening simultaneously, well, that's definitely, that results in a reversion to the downside, and then you test that and you really start to see, that's a ridiculous notion that really, you were subject to a confirmation bias where you thought that's what was happening, but you were only noticing the times it happened. And actually, there's so many other times. In fact, the majority of times, it didn't work, or the way you have the entry and exit and the risk management isn't working. So that the discovery process may lead you to abandon some cherished notions. It may lead you to abandon some previously cherished metrics too.
When you need to build up your team to handle the growing chaos at work, use Indeed Sponsored Jobs. It gives your job post the boost it needs to be seen and helps reach people with the right skills, certifications, and more. Spend less time searching and more time actually interviewing candidates who check all your boxes. Listeners of this show will get a $75 sponsored job credit at Indeed.com/podcast. That's Indeed.com/podcast. Terms and conditions apply. Need a hiring hero? This is a job for Indeed Sponsored Jobs.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved, now so has the way traders operate within them. Trade the Pool.
When developing a strategy, still during this development phase, can you speak about how you think about simplicity, and is there a place for complexity in what you do also?
Right. Simplicity, and this probably is touching on our last conversation, but simplicity is a huge thing for me because for two reasons. First of all, that's just generally philosophically resonates with me that simple things are more robust. There's a Mandelbrot quote, which is very beautiful in this regard, related to simplicity, simple rules, and so forth. But also, my study of kind of first generation commodity trend following traders, and there's some great books out there on this group, really emphasizes simplicity as well. And so I was influenced by that, even though I'm not in this strategy, I'm not doing futures and I'm not doing trend following in the pure sense. I'm doing equities and mostly reversion, so almost the opposite in a sense. Nevertheless, I was influenced by their emphasis on simplicity. So that has served me well, because the thing about complexity is what ends up happening is if you're, in all power to those who can have really, really complex, maybe convoluted is not the right word, but ornate code and complex rules and if-thens, out the wazoo. If they can get that to work, that's fantastic. All power to them. However, what typically happens with most people who try to do that is they create an artifact, basically a really, really elaborate way through the past, right? Because all financial models rely on the past. And so we want to avoid complex travel routes that are overly tied to one place and time. They're overly specific. That is too complex. What you really want is, going forward, you want to be able to generalize well, because data, markets are not stationary. The data can change. Regimes can happen. Decimalization can happen in the stock market. Regulations can change markets. There's just so many things that change. Obviously, technology, market microstructure is hugely changed in the last 10 years. I think the average shares stock trade was like 2,000 shares maybe in 2005 or 2006, and 10 years later or thereabouts, it's like 200 shares. Might even be less, but that's a general idea. Micro structure can evolve. So basically, long-winded way of saying that it's important to really have simple rules that can really walk through and navigate markets that are going to be different in nature in the future than they are on now and on the data, which is yesterday, that you tested on. If you're overly specific, overly complex, you're probably going to just break apart in the future. It's going to come unglued because it was just too brittle. It's funny. You can even see this on certain parameters. For instance, and maybe this is too much detail, but you can do a parameter step, let's say on one piece of logic, one variable in the test, and you can find a parameter shelf, imagine like a ledge. You can find this narrow little ledge, above a 1,000-foot precipice that you can walk successfully. And boy, that would have been great in the past if you had used that parameter. And then you can step right, one parameter to the right, so to speak, of the one you found that worked, and you're falling off into the precipice because it didn't work. That's not a robust piece of trading logic. If you are narrowly finding the rule that worked, and you're not seeing that one wrong move and you fall off a cliff. So that's the risk of overcomplexity.
All right. So I just want to pick up on that. So I think just to sort of summarize what you're sort of saying there is, let's say your strategy uses a moving average of 20 for some parameter. It's just one of the trading rules. It involves a moving average of 20. If that moving average was 19 or 21 or 22, what you're saying is that if that produced completely different results, like vastly different results, it's quite a brittle strategy. Am I understanding you correctly there?
Yeah, perfectly said. Perfectly said. In fact, you can just replace what I said with that, Aaron. That was perfectly said.
Okay. And I actually remember when you were on last time, you described these commodity CTA futures traders as their strategies were so simple that they could actually be written down on a napkin and followed, and they made a lot of money doing that. So
right.
That's one thing that sort of stuck with me. Also, when you were on last time, you used this term degrees of freedom, and I think I kind of glossed over this. I think that's maybe quite an important point, which we didn't really go into too much. Can you talk to us about what you mean when you talk about degrees of freedom in a trading strategy and how it's a positive thing?
Sure. Yeah. Now, that relates to statistical significance. So the idea is, and it relates exactly to what we just discussed. So if one has 20 data points, let's just make it real simple rather than, thousands of data points. If one has 20 data points and has 19 rules or 20 rules related to a system that works over those 20 data points, or let's put it in another way, maybe you have 2,000 data points, but you have 2,000 rules. There are no degrees of freedom, and you have created most likely an artifact rather than something that is fact in a sense that can live on its own and work and generalize well going forward. So the idea is to have, let's say, those 2,000 data points, but have a minimal number of rules, so that therefore there are greater degrees of freedom. And at the risk of being completely non-quantitative and non-statistical, I always think of Robert Frost, and I might butcher this, but he said something to the effect of, I don't know whether it was poetry or art, but I think it was specifically to poetry. I think he said poetry is moving easy in harness. Because when you're developing this logic, it is a harness, it is a constraint. And the rules are they're fastened, right? They're hard coded and they're fastened on the horse, if you will. And yet they have to be able to, the strategy has to be able to navigate the different terrain. You have to be able to move easy in harness. If you're too confined, you have no degrees of freedom, and the strategy is not going to be viable. So kind of a mixed answer to that, partly referring to the statistics of it, of statistical significance, and partly just the way to imagine that, or at least the way I imagine that.
Also, just going back to when you were on last time, you mentioned that backtesting poorly is very easy to do, and I think that kind of leads us into the next step after sort of thinking about your strategy idea. How do you actually go about backtesting that, and what are some of the ways that one can backtest poorly?
Wow, there's so many, Aaron. How long is the interview?
As long as you want.
Well, I would say having poor data, that would be a bad starting place. You want high quality data. I met somebody, brief anecdote, I met a young guy who had an economics degree from from a prestigious school, and he was talking about a system that he had just started to develop on weekly data. And I asked him about, well, weekly data. Okay, what about the, in between those weekly data points? Is there anything that, have you done any research there into that massive gap of time between these weekly closing data points? And, and he hadn't. So you have to think about your frequency and what's missing from your data. If you use end of day data, well, you don't have that intraday low or high that maybe blew up your system or was too uncomfortable to keep trading. So one has to think right away about the data. What's the data I'm using? Is it good quality? And what's it missing possibly? So that's the first thing I would say. Secondly, if one creates a strategy and it looks phenomenal, but that developer really, really couldn't articulate what's going on. Back to the panel discussion that, we had early as you were asking about these, these competitions. If one couldn't be grilled and come up with really cogent answers as to what the logic is, why it's working, and be able to articulate one's investment process and one's edge, if you can't do that, that's probably a sign that you just created something that you don't really understand and that probably has some flaws. So maybe not necessarily a way to develop poorly, but that would be an issue to me. One really has to understand each aspect. I have a strategy that has it's a singular strategy, but it has 9 systems within it, and a 10th is being added related to adding a positive volatility element. And each of those systems was is very familiar to me. It was not a hodgepodge of rules and logic that I don't really understand. So, in my case, that works for me, and I think that's probably important for most developers. A machine learning process is different. One should really understand that. There's a lot to understand there. Maybe the whole process is finding things that you may never have come up with. That's a different thing. But if you're doing kind of traditional development, I think you should be familiar with the ideas and the logic and be able to articulate it. So those are 2 ways. I would say not being statistically significant. So if you have if you have 30 trades and it's a phenomenal system that works on the lumber market, and yet you only have 30 trades in your model, and is that meaningful? That's a statistical significance question and a degrees of freedom question and a robustness question. Better you have thousands of data points, not just 30. So I could go on, but those are a few. I'll probably think of more later and circle back.
Yeah. So just to pick up on that last point there where you said, it needs to have statistical significance. If there's only 30 trades, 30 data points in your back test, it's not very significant. It doesn't really tell you that much. Every trade is different in this sense, but for you, what's sort of a rule of thumb for something that is statistically significant?
Well, it's a good question. For my strategy, let's see, I think they're essentially, generally speaking, there are about maybe 12 to 15,000 data points, and under 50 rules perhaps in total. That's something actually I'd have to go back and quantify. I might be off there a little bit, but in other words, I have a very, very low rule to data point number and ratio. So that was important to me, just to have a lot of data and to have a lot of degrees of freedom, back to that discussion. Okay.
So you said somewhere between 12 to 15,000. Obviously that's very relevant to you. You're trading a universe of many, many stocks. I'm not sure how many exactly. So there's going to be a lot of data points in that. For someone who might just be starting out, let's say they've got a strategy that only trades on one particular product or across, a very small universe, would you say maybe something like a few hundred trades is going to give you some significance?
Yeah, my answer to that would be most likely yes. And secondly, does the logic work well on related markets? So if one has a great 10-year note futures strategy, does it work on the 30-year futures? Does it work on the 5-year notes? This is something that I would investigate. That would go for stocks. Obviously, if one had a stock-specific strategy, can it work over a portfolio of stocks, not just a single name? I'm a believer in the portfolio approach, but it really differs. With stocks, that's quite helpful, and working the sectors within the stock market, that rotation in and out and so forth, even if it's fairly short term. But I would think a few hundred data points, and does that same set of logic, the same rules, do they work on related markets? Probably not as well, but do they at least have a positive expectation? That's something I'd look for. If it falls apart on every other market except the one that you developed, that is probably a red flag. Okay.
I'm glad you added that last bit at the end, because that was going to be my next question. I was going to say, what if it doesn't work on, like you said there, the 10-year note, and then you try it on the 30-year note, and it sort of falls apart, then that is an obvious red flag. So, thanks for adding that. Now, here's something I want to ask you a few questions around, and that's curve fitting. So we've probably already touched on some things that are relevant to curve fitting already, but let's just break this down. So what measures do you take to reduce curve fitting?
Well, I think we've already discussed nearly all of them, actually, because it's avoiding a too high rule to data ratio, right? So in other words, minimize the rules and the logic, avoid complexity. Simplicity doesn't have to be simplistic. It can be sophisticated yet simple. Most formulas, that are really powerful are incredibly elegant, like the fractal formulas. I have a book on, and I'm going a little tangent here, Aaron, but I'm fascinated with really complex or seemingly complex things, phenomena in nature and so forth, and the fact that many of them can be reduced to really elegant, simple formulas. Obviously, not all the time, but that is often the case. So I think we have talked about a lot of them. It's really avoiding the complexity, embracing the simplicity, having simple logic that can generalize well, quality of data, and in terms, let's see, more specific, maybe something I haven't said. If one is not reserving data, and that's something we haven't talked about, so this is critical. If one is not reserving data that never gets touched, the trading logic, the whole development process never sees this data. This data is completely quarantined, like it has the bubonic plague, just sealed off, never gets seen. That data should be seen once and only once, purely out of sample. Most people, developers don't, they don't do that. Obviously, sophisticated, more scientifically oriented, modelers are going to do that every time. However, your maybe average trader who just says, hey, I want to get into, trading logic now and develop something quantitative or systematic, might not be rigid about that. And that's crucial. So that's very important. One has to develop and then flash that data once, essentially, across that out of sample data. And, if that doesn't work, you really have to go back to the drawing board. And you also have to realize that if that doesn't work and then you go back and tweak it some more on your your development data, your testing data, your training data, essentially. And then you go, you are now, that data is not out of sample anymore because it's informing your changes. Maybe the strategy was great on the out of sample data, except for that 9/11 or something, in market terms, it was pretty horrible. In other terms, of course, horrible. But and then you go, well, gosh, if I just changed the holding time, I could have avoided holding in, to that day, and avoided that drawdown. And suddenly now my results look great. Well, you just use your out of sample data to you just burned that up too, because that's no longer out of sample. It just informed your further development. Now, what data? Do you have a second set of data you can test on? That would be a good idea too in that case. So I would say that's something we haven't talked about that's really important to avoid the curve fitting, or at least to verify that you most likely have not curve fit.
Yeah, that's a very good point that you do highlight there is, once you have run your strategy or your idea over your out of sample data, and then you go to make some changes and do it again, that is essentially all now in sample data. So, it's just something that you need to be aware of for sure. Are there any telltale signs that you have overfit?
Well, that summary or that equity curve, when you go and go to the out of sample data and it looks completely different than your very smooth development equity curve, obviously that can be a glaring, hard, impossible to ignore sign that you have developed a curve fit model. Obviously, Real Performance, you launched that strategy on Real Money now, and you are not seeing, you're immediately breaking metrics that shouldn't have been broken. Maybe you have maybe the worst drawdown perhaps in all of your backtest period was 5% or 10%, and you're breaking that within the first month of trading. That's certainly conceivable that could happen if perhaps it's a similar market condition type of scenario, but that could also be a very bad sign that you have a curve fit model that was just too fit to the past, and now that you're running through the present and future, it's simply not generalizing well, and it's falling apart.
Okay. So with that in mind, how do you begin trading a new strategy? So let's say you've gone through all your development process, you're happy with how it looks. How do you actually start trading that in a live market? Do you start with small size? Do you trade it still on a demo account for a certain period of time, or do you just go all in?
Yeah, well, that's a good question. Obviously, that's going to differ by individual. I don't think there's one right answer to it. Obviously, there's just degrees of conservatism versus, gunslinger. Really, I'm never a gunslinger, so I would wade into the water and test it that way. On the other hand, if one is paralyzed by fear, one just is still afraid that the model maybe is not going to be effective, you could find reasons to delay for a really long time, and that that's obviously not a good scenario either. So, I'd say it's personal preference. Perhaps the smartest way to go though would be to, depending on the nature of the demo. I mean, markets are going to be different and the demos can be different. If it's spot Forex and suddenly you have the greatest spreads where they really don't exist in, where you'll be trading that strategy, then your demo results are meaningless perhaps, unless you can build in those assumptions. And that was another thing that we didn't touch on, but have very conservative assumptions. Don't assume that you'll get filled at your limit if you have limit orders in your model. Look for those limit order prices to get exceeded and then count that as an entry. especially if you're looking to develop something with high capacity that would be trading a lot of money. So anyways, short tangent on that, but I wanted to mention that. So in terms of rolling out, a demo is a good idea, but just be honest. Look at the nature of the demo. Is it really modeling what your fills and commissions will be? If it's not a situation where you need it to be handling a lot of capacity, a lot of money, assets, and so forth, then that's maybe not as important. But of course, if one is developing a hedge fund strategy, for example, and it's a high capacity strategy, how do you model market impact? Right, your very order in the real market could displace, like elephant in the bathtub kind of situation. It could displace the marketplace. It could have a market impact, and your actual fill, therefore, would be quite different. So if you're in a really illiquid market, you have to think about that. Or if you're trading huge size, or you intend to be, then that's a factor that you have to take into consideration. Now, most people are probably not going to be, modeling for very illiquid markets, or necessarily trying to develop a $1 billion dollar capacity strategy, for example. But those are factors, and my approach in those different scenarios would potentially be different in terms of the rollout in those scenarios.
Yeah, absolutely. Both are really good points. Now, I don't think I've ever asked this question before, but I think it's a good question. Do you have a life expectancy for your strategies? So once you start trading them, do you have an expectancy? Like, do you think that this is going to last for at least 5 years? Do you think it should last forever? Or are you with the sort of thought that, an edge will not last forever?
Yeah, that's a great question, and somewhat unknowable. So I've met, I'll answer the question in a second. I have met two, I divide them into two buckets. Other traders with quantitative systematic strategies. There is one group, in fact, a hedge fund that is quite sophisticated and pretty large, where essentially they are constantly adding new edges, retiring edges, modifying, updating parameters, so on and so forth. So it's like a constant living, breathing, evolving strategy. And that would be hard potentially for a small player to unless very capable with modeling and data to keep track of that model over time. But that's one bucket, that's one approach, and I've met some groups like that and some individuals like that. Then there are other groups or individuals that really stick to the hey, this is it, this is my logic, and I stick with it. And I really haven't modified it. There was that one tweak back in 1992, but since then, and there are those people out there, and I've met them as well. So there's not one approach to how frequently one. I don't think there's one set of rules that say you have to never alter your model, or you should constantly alter it. There are diverging philosophies around that. In terms of my own life expectancy for the strategy, based on my model, my expectation is in its performance over almost 6 years is that it should continue to navigate markets well, because again, back to simplicity, the simplicity of the logic. In my studying of and testing of markets over a long period, other periods of time, data that goes way back, 60s, 50s, and earlier on than that, when you can get that data. I have reason to expect that, that the strategy should continue to perform well. But I don't necessarily think that it will be without some revamp. There, just to take one example, obviously all stock traders know or should know of, the 29 crash, the 87 crash. I've met many people who were wiped out in the 87 crash or just took their puts off right before the crash. And, that was a life-changing decision. The biggest option trader in the pit who, lost it that day. Great guy. And, these were life-changing events. But essentially, I was going to mention 87. Essentially, that crash, there is a change. There was a bit more propensity for momentum prior to that fall of 87, and after the crash, reversion worked a little better in equities. So, there are these, obviously it's a dramatic event, 87 crash, but, there are these changes in markets that can produce new tendencies. And so I think, to put it simply, that I will adapt to those, hopefully, but I expect it, in lieu of something like that, I expect it to continue to perform over time, just due to the simplicity.
Yeah. And I just want to throw in there, guys, if you want to hear more about the 87 crash and someone who actually made a lot of money on that day, listen to the interview with Blair Hull, who bought the lowest tick of the day on the 87 crash. Yeah, pretty incredible.
Good recommendation. Yeah, it's phenomenal.
So with all this being said, how do you monitor your performance when live trading? Like, how do you know everything is doing as it should be?
Right. I think that's a keep it simple approach. In other words, what metric or metrics should one monitor? There are the obvious ones, such as rolling return over various windows of time. How's that stacking up over time? Is it deteriorating? Is it maintaining? Is it a slight deterioration? How does that compare to the model? The same with drawdown. Dr. Howard Bandy has some great books on trading. I highly recommend. And in at least one of them, he talks about winning percentage can be a good monitor. For example, just and he doesn't employ portfolio approaches, I don't think, but on a trade basis for the system, what's the winning percentage over various slices of time? Is that deteriorating? That could be a canary in the coal mine saying, one's edge is decaying. And so I don't think there's a one size fits all there, but I don't think it needs to be incredibly complex either. So there are some basic measurements to essentially look for edge decay. And if I could rant real briefly for a moment, there's this objection to systematic and quantitative trading. Sometimes you hear people will say, "Hey, well, I've never seen a bad back test." Ha ha, meaning, it's a survivorship bias free thing, or a survivorship bias thing where, you only the good back tests win and all the other back tests are deleted or sitting in a hard drive somewhere. So, there's something to that. Obviously, no one pursues a strategy with a negative mathematical expectation. It has to be positive. That goes without saying, but so that objection bothers me sometimes, like just because the fact that people pursue winning models is somehow inherently flawed. But what is flawed, and what every or not flawed, but what every quant or systematic trader has to have an answer to is how your question, how will you know when it's not working anymore? Because some people do object. They say, "Hey, I had a quant, had an experience with a quant strategy, and it worked until it didn't, and then it blew up, and I'll never touch one of those again." Obviously, I had a negative experience, and it's really crucial for I think every systematic or quantitative trader or manager to have an answer to to that edge decay question, and it works until it doesn't. What's your answer to that? Because if you don't have an answer to that, then that could be a problem, whether you're just trading it for yourself or whether you're trying to go out into the world with it.
Good, Ron. I like it. Is there any other misconceptions you'd like to get off your chest?
Wow. Probably, but they don't come to mind at the moment. No, I think that's my singular rant right now.
Okay. Now, we were speaking the other day prior to doing this interview right now. One of the things you mentioned to me was that you were thinking about sort of doing things a little bit differently this year. You'd like to kind of explore some new things. I'm not saying you're going to ditch your strategy that you've been running for 6 years. Obviously, that's going to continue, but you're looking to explore and look into some new things as well this year moving forward. Can you tell us a little bit about what some of those things may be?
Yeah, absolutely. And that's always exciting. I think you have to be fascinated with markets to really succeed in them. Maybe that's not true. Maybe there are people who are just cynical and just develop strategies and they make a lot of money and they care less about them. But it hasn't been my experience. I think most people are deeply interested, and that fascination serves you well, especially in hard times when maybe you're in a drawdown. In terms of my development list this year, it's something that I've really started to codify in the last couple of weeks for the rest of the year. Is relates to a couple different areas. One is just having a better data infrastructure, and that this is the decade of data, as a lot of people now call it, have been calling it for a few years. Where I forget the stats, you might know, Aaron, but I mean just essentially the bulk of the world's data has been created in the last few years. Essentially, it's really just a phenomenal fact. However close to the truth my summary is there, but. So essentially a better data infrastructure and more tools to manipulate data, and essentially making, because data prep is really a lot of testing, whether you're doing data visualization, maybe it's non-market related, doing word clouds or, web scraping, and then trying to find some intelligence through that, or obviously in the trading realm. Simply looking at correlations and looking for other relationships that might be interesting with, new volatility indices related to, a strategy you already have. I mean, there's such a richness of possibilities. So having the data, a better infrastructure, it's kind of a boring topic, but that's something that I'm working on this year. And really that will enable me to work through just many ideas more quickly. So a lot of them are related to just analytics or enhancements on my current strategy, the equity strategy. There are, other asset classes that I'm developing edges in, and that's usually how it starts, which is develop an edge. It works in a lot of currency pairs, or it works across related futures markets. And then from there, one can, delve further into, how can I exploit this? What capital would I apply to this? Obviously it raises a lot of questions, but so I have a deep list there. / far out stuff perhaps is just looking at various whether it's fractal formulas or formulas related to biology and so forth. Those are things that I'd like to go deeper into, but they're a little further down the list. So, it's I think we might have talked about it, Aaron, just casually the other day, but the separating one's isolating oneself away from distraction is really, I think, crucial for development, at least for me. So that has to be a very, specific time of day. has to be the right day. It has to be or a regular schedule. Whatever it is for everyone's going to be different. But I'm a believer in intensity, not necessarily time. Having the schedule is good. Having the time set aside is important. But then intensity, being undistracted, so you can have long thoughts. I think that's really important. And I just mean uninterrupted thoughts where one can just go through a hierarchy of logic in one's mind as one's coding, keep that all there, cached in one's mind as one's working. That's really important to my process, because if you allow the constant interruptions, then you can lose some really phenomenal things that you might be on the verge of developing and codifying. So kind of a long-winded answer perhaps to your question, but those are just a few of the areas that I'm really looking at and how I think about them.
Yeah, no, I like that. And I think we'll have plenty to talk about next time you're on as well, by the sounds of things. I'm blanking on the man's name at the moment, but he wrote a book called Deep Work, and it sounds as though I haven't actually read the book. I've read like a few reviews and a bit about the subject, but it sounds as though that's kind of like what you're talking about there. Another word for it is deliberate practice. It's one thing to spend a lot of time on something, but are you actually spending that time in the most efficient way? Like, are you actually, totally engaged with what you're doing, or have you got distractions coming left, right, and center? You know what I mean?
Yes. Yeah, I don't know that book, but you can tell me about it later. I'll Google it, whatever. But yes, that's absolutely. I'm a believer in that, and I'm older than you. I've always had a serious bent, but when you see your own theta, your life as time decay, which sounds pretty dark, but just putting in option terms there for a moment, but you do dig deeper. I do anyways. Just dig deeper and go, all right, this and this other thing and this other thing, they have to fall away because they just don't rank anymore. I thought I would do them. I thought I'd get to them, but I'm jettisoning them because I am doing this and I'm doing this other thing, and that's it. And, you said deep work. I think you use that title. I just think of it as long thoughts, and I also that phrase intensity, not time, because you can have a block of time and do very little with it. But you can have less time and do tremendously well with it. One trick, I think I saw this, I've been using this trick for a while, and I don't use it every day, but I get into periods where I use it, where I had set a little kitchen timer, a little egg timer, and that's a nice trick because you can set that for, 25, 55 minutes, whatever it is, and that's your focus time. You can let nothing go except your task at hand for that period. It's a little, it's just a little kind of a crutch or device. Obviously, for longer things, it's not going to work. But for tasks, staying on task, it can be a good device.
Yeah, that's called something, that tactic, isn't it? Is it Fedora? Something like that. I probably just got that really wrong, but
I don't know. I did see I saw an article within the last year. It's like came in my inbox, and it did have a name. So I guess it has a name.
Yeah, well, you spend like 25 or 55 minutes or a certain period of time, and you just purely focused for that amount of time, and then you have a 10 or 5 minute break. Where you just do absolutely nothing. You just kind of zone out and then just smash it again for another 25, 55 minutes, whatever it is. Yeah, I've read a couple of things about that actually. But just going back, the man who wrote Deep Work, I can't believe I'm blanking on his name right now, but I'm actually trying to get him on the podcast. Not a trader whatsoever, but
Excellent.
Obviously I think, a lot of what he talks about and is knowledgeable about will be very relevant and beneficial to traders and obviously listeners of this podcast. Just speaking of talking about your life in terms of theta or decay and being kind of dark, you might appreciate this as you appreciate data visualization, but there's this very, very simple chart which I've seen floating about online, and across the x-axis, it's got weeks and a year. Okay, so it goes from 1 to 52. And then down the y-axis, vertically, it's got ages. So going from like 0 to, I don't know, 100 or whatever you live to. And each little circle on that chart represents 1 week of your life. And I just think it's so powerful. My girlfriend's heard me go, mention it. And she thinks it's really dark and kind of strange. But I think it's really motivational. I think it's very powerful to look at and see things displayed like that.
I'm going to look for that, Aaron. It makes me think of, I like to sit in Zazen, just a traditional, simple sitting Zen practice. And Dogen, a Zen master from, 1200, I think. I'm probably off, but at any rate, he's kind of revered just for his writings. And I think it was him, although maybe it was somebody else, but Dogen was quoting him, whoever the other, Zen practitioner was. But bottom line just said, sit like your head's on fire, which to me is, sit with intensity and practice now. Carpe diem, essentially. So that can be applied in all aspects of life. So I think about that a lot. I think about just solutions. There's so many obstacles to anything great, trying to be great, that you have to push through obstacles. So, solutions is just another mantra. I think about that every day. At some point, I just go, solutions, man, just got to find the solution to this. And it might not be trading related. It might just be, life. But that, these things are important, I think, for the trading mindset. I mean, we're talking about quantification and in data and logic and so forth. But there are times that are really challenging as a trader, and you really have to have a resiliency mentally that can be multifaceted, from staying fit to having just doing the things you need to do. I chill out incredibly deeply, unless I can't, but on Sunday, at least for the afternoon into the evening, and I don't look at screens usually, and that's just like, that's absolutely, it's like a refresh thing, so I can start Monday full force, and I completely slowed down. So they're just little tricks like that. Everyone has their own way, but I think they're important to have that healthy mind and so on.
No doubt. On that point, Dave, let's sign off. Where can listeners go to find out more about you?
Sure. I would say, alphatative.com. That is a website that people can check out. And, I'm on Twitter at alphatative. I'm not super active, but, those would be good places to look.
Okay. And do you just want to spell out alphatative for us so that listeners can easily find you on Twitter?
Sure. It is alphatative.com or alphatative. There you go.
Yeah, at alphatative on Twitter or alphatative.com. And what's the go with your site? I've been to it a few times. You've got to sign up to view it. Is that correct?
Yeah, that's right. And that's something I can't really talk explicitly about. But in other words, it is not available unless you read through that and then agree to those terms, because, just the nature of the alphatative activities. Exactly. So unfortunately, that's what I can say. So, just meeting requirements and regulations there.
Yeah, it's there because it has to be.
Thank you. Perfect.
Dave, I'm very grateful for having you back on, man. It's been an absolute blast. Thank you very much.
Aaron, a pleasure as always. Love what you're doing. Keep it up. And, thanks for the opportunity.
Sure thing. We'll talk soon.
Beautiful. Thank you.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Hey, it's Ryan Reynolds here from Mint Mobile. Now, I was looking for fun ways to tell you that Mint's offer of unlimited premium wireless for $15 a month is back. So I thought it would be fun if we made $15 bills. But it turns out that's very illegal. So there goes my big idea for the commercial. Give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3 months, $90 for 6 months, or $180 for 12-month plan required. $15 per month equivalent. Taxes and fees extra. Initial plan term only. Greater than 50 gigabytes may slow when network is busy. See terms.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured by one standard: disciplined risk management and consistent execution. Meet that standard and you operate at scale. No subscriptions, no ongoing obligations, just a clear path forward. For those ready to trade beyond limitations, this is the next level.
This episode is brought to you by Accenture. When your advertising operations fall out of sync, everything else follows. Spotify and Accenture are working together to reinvent the rhythm of ad sales, using automation, analytics, and smarter workflows to simplify campaign delivery and access better data across the business. The result? Less time spent on operations, more time connecting brands with the moments and fandoms that matter most. Learn more at accenture.com/Spotify.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
How are you doing, folks? Thanks for being plugged in. This episode is number 112, and my guest is Jorge Soltero, who currently resides in Puerto Rico. For a quick snapshot of Jorge, he began as a floor trader in Chicago, where he was an options market maker. A few years into his career, he landed a position at Hull Trading. This is the renowned firm of legendary trader Blair Hull. After Hull Trading was bought by Goldman Sachs in 1999, Jorge became more of an institutional trader, not only working at Goldman, but later UBS and Merrill Lynch too, where he specialized in options and ETFs. Listening to this episode, you're going to hear about the culture of trading pits, exactly what it was like to be a trader at Hull Trading, what makes ETFs an attractive product, amongst many other things too. It was fun to chat with Jorge. I hope you enjoy listening to our conversation. Here it is.
Good day today. I caught a bit of that rally in the U.S. equities. The dollar is actually didn't see where it was settling now, but I'm always fearful when Trump is talking. These days, he seems to turn things. Whatever what was happening before he started talking gets reversed. But no, today was actually all right.
Now you're living in Puerto Rico, correct?
Yeah.
Okay. And how long have you been living there for? I know you were originally born there, and you've just moved back there recently. How long have you been back for?
Since August of last summer, so just coming on 6 months.
And what's it like there? I imagine it's a pretty laid-back sort of place, or is that just sort of how the movies portray it?
No, it is. It's not a full-on resort island by any means. There's a metropolitan area. There's 1.5 million people live in the city. So it's there's good bits of culture and, cinemas and auditorium and, concert halls and all that kind of stuff. It's a small city. And then it does have its laid-back island kind of beach vibe as well, but it's not all flip-flops and shorts like you would think in the Virgin Islands or something like that. That's you have some commerce, but no, Puerto Rico it's a bit. I like to think it's the best of both.
great weather year round, fun people, fun things to do. Not quite the hustle and bustle of London by any stretch, but then it's always going to be over 25 degrees here.
Of course. And does Puerto Rico have a stock exchange there?
No, nothing like that at all. I always thought, in terms of finance, Puerto Rico would be a great bridge between. So politically, Puerto Rico is part of the U.S., but not a state. But when it comes to finance, it's all U.S. regulatory stuff. The tax regime is a little different, but in terms of regulations, it's U.S. So I always thought Puerto Rico would be a great bridge between Latin America, say, and the U.S. for money coming in both directions. Never really caught on for some reason. There's a few public companies, a couple of big banks that trade on the stock exchange here. They all have reasonable businesses here for mostly retail finance and some investment stuff that goes on here, but not as an exchange or anything like that.
Yeah, I had no idea that Puerto Rico was part or owned by the US. Shows you how much I know.
It's a little far away for you for it to be on your radar.
Yeah, I guess so. So you moved to the US for study, going back to once you finished schooling and that sort of thing. You graduated from your studies with a degree in philosophy. How did a philosophy graduate get interested in trading?
Well, it's really because I was in Chicago. So in Chicago, you had the three major exchanges, as I knew the world at the time, this is coming on 25 years ago, the Board, the Merck, and the CBOE. So you were going to run into traders no matter what you were doing on any Friday, Saturday night. Some of my friends went into that bit of the business, and it always sounded pretty exciting and interesting to me. I'd seen it in Trading Places and Quicksilver, a couple of old movies. And all of a sudden I realized, wait a second, I got these three exchanges here in the city. You could go visitors gallery. You could interact with the guys. You just stumble and they're like, hey, how you doing? So I managed to meet a couple of them through one of my other jobs before this. And they said, yeah, just if you want to do this, just come on down and do it. Don't overthink it. Don't try to start doing it part-time and then maybe get into it. Just come down to the floor and, get a job. So I got a couple of interviews with market making firms, and they always give you puzzle questions to kind of test out your math. So it's not I'm guessing it's probably much more rigorous now than it was then. And so I made my way through the puzzle and the quick thinking math questions that they asked me. And so the philosophy degree was just kind of an amusing thing for the people that were interviewing me to talk about, because as far as they were concerned, it was a degree from the University of Chicago. They were happy with that. They figured anything I needed to learn about options trading and risk management and market making, all that stuff, they would teach me, or I'd pick up from the floor. I wouldn't have learned in school anyway. And so that's sort of how I ended up on the trading side.
Okay, so when you were going for these jobs as a trader, did you actually have a job already, like at the time?
Yeah, my first job was not in this business at all. I was working for the Archdiocese of Chicago at the time. So it was just, an administrative job. But one of our board members was a bond trader. And that was my first interaction with real pit trading and that sort of thing as it happened in Chicago. So through him, I met some other people. And then I realized a couple of my friends had gone on to jobs in that area. So then I left that, and fortunately, it wasn't a walking away from a big salary to a trading kind of job with all the uncertainties that brought along. And I was younger, so it was a good time to make the transition, a good place to make the transition from.
And I'm just curious, you said that you had a few friends who were into trading. Going back, 25 years ago now. Are any of those friends still in the business?
A couple of them, I believe they are. The guy who introduced me to the firm I ended up joining, I actually don't know. I lost track of him. But a couple of the other ones still are. None of them are on the floor anymore. They've all gone on through to different things through the firms that they were with, and ended up upstairs. And some run their own firms now. Others are still just making a living, trading their own books, but doing it upstairs, and it's much more automated. Now, from my San Francisco days, which was a few years after that, that was an interesting breakup of the crowd, because it wasn't so much automation that broke up that floor. It was multiple listing. So San Francisco floor used to have basically a monopoly on a few technology stocks, including Microsoft and Cisco, Sun Micro. When multiple listing came around, and the SIBO and Philly and other places listed options on those stocks, a lot of the business drained away from the PICOs. So those guys kind of had to figure out something else to do, and many left trading to do other things. Some in finance, some in real estate, all over the shop, really. But their edge from being good pit traders in the PICOs, once that was gone, they knew they had to move on, and they're no longer doing that.
Yeah, that's an interesting subject, and I'm going to pick up on that in a little bit. Let me just ask you, though, what was your first job that you got in trading? Who were you working for?
It was a small market making firm called Apollo Trading, turned into Apollo Derivatives later on. And that was one of the guys, maybe both actually, I don't remember exactly, was XCRT, Chicago Research and Trading. And I was a clerk in the currency pits at the Merc. So I worked for a couple of the currency traders. Deutschmark at the time was one of the main currencies that traded in the Merc floor. It was D-Mark, yen, and the British pound. And I alternated and clerked for traders in those pits for my first year there, maybe first 9 months before I actually started trading. Always on the options side of things. So these were options on the currency futures. Reasonably busy, because you get a lot of hedging and offloading business from the big banks. So the futures pits were very busy. The D-Mark pit was huge. The yen was very busy, and I remember it was hovering around par for a while back in I think this was 94. So it just generated a lot of activity, and it really was the stereotypical, really noisy, very physical job. You see it actually in the Ferris Bueller movie. They have a shot of the Merc floor, and it's a currency floor that they're showing. And I was one of those guys in the yellow coats, giving signals and yelling out prices, and looking after traders all the time, trying to learn the market making business from a floor trader's perspective. You're using sheets, you're running P&Ls, you're running risk reports, you're following the order flow as it comes in from the floor brokers, giving orders out into the pit, people replying back with markets, everyone fighting to get a piece of trade, and just really trying to capture a bid offer, getting their hedges in, all done either by yelling or hand signals and stuff like that. It was controlled chaos. And after that, we moved, the firm wanted to go into the Eurodollar futures, which was an enormous pit. This was football field size. And the options were on one end, and then all the other different contracts traded across the room. And I guess there was thousands of people in here. And it really was a physical job there. You needed to be tall, you needed to be aggressive, because you needed to make yourself seen and heard across an enormous amount of people and enormous amount of noise. So we tried to break into that pit. That had mixed results. It was an interesting way to trade, because it's not the most dynamic contract in the world. It tends to move and trend, but the option side were pretty busy, and there were some guys who were making a ton of money that were not super sophisticated in terms of the systems they were using, or the option pricing systems they were using, but they were just really good at capturing the bid ask and spreading in and out of trades to lay off risk in what was a busy contract. So that's it was in that pit that somebody said, you never want to be the biggest trader in any one pit. You want to be at best maybe the second biggest. And I said, what do you mean? And he's like, well, you always want someone to get out. And that at the time didn't make a ton of sense. But as I developed as a trader, and as I saw other things go through in the business, you realize, yes, you need, who are you unloading your position with if you have to, or if you need to, or, something happens, you need liquidity. if you're the main liquidity provider in a pit, you can end up stuck. So it was one of those things where you, after years, you see the number one trader, the biggest trader in a pit, that position changed a lot. But the top 5 after that, they're usually the same guy.
I feel like I've heard someone else who was a floor trader on the podcast on a previous episode mention something similar. So it's really interesting that you say the same thing. You know, when you say these pits were very, you had to be very aggressive and they were very physical, how physical did it get? I mean, were there times when fights actually broke out?
Yeah, there were. It was reasonably controlled, and these were people's livelihoods. So in general, although there were scuffles and shoving matches for sure, you wouldn't see a ton of activity like that on the actual floor because people would get fined, or you'd get thrown out. And nobody wanted to, you pay a fine, and I hesitate to admit, but I got fined myself a couple of times, not for physical stuff, but for using non-business-like language on the floor. But no, people would actually walk off the floor and go to one of I forget what they called it when I was at the SIBO, but it was like, oh, I'm meeting you at the whatever. And you'd go, and sometimes they would actually fight. Sometimes it would get stopped before it started. It would get physical. When you think about it, I mean, you had all kinds of people with different backgrounds down there. It was everyone's livelihood that was at stake to some degree, different personalities. And you had, it's the job in a way I find unique because you spent all your day next to your competition, not your coworkers. So if you work for a trading group or trading firm, your other workmates would be in other pits. I mean, maybe there was a second trader in the same pit you were in, but by and large, you're spending your day with your competition. You're making markets against them. You're trying to get pieces of trades that they're doing the same thing. So it's a reasonably full-on competitive environment, and inevitably somebody would lose their temper, and it would get at least a shove of some sort, and somebody would cooler heads would prevail eventually, only because people are like, listen, you're going to get thrown out. Worst case, you could get arrested. Nobody wanted that. So, but yeah, people did leave the floor to go settle slights, real and perceived.
That's kind of funny. It seems almost like very schoolyard-like.
There were some rules that were, things that set off arguments. I mean, it's crazy things like your spot in the pit. It mattered. Where you stood relative to the order flow mattered. And there were some spots that were better than others, and some guys that were taller than others that, the taller you were in some of these crowds, the more real estate options you had because you were tall. If you weren't that tall, then you needed to be closer to this guy or closer to that other guy. And people would get in very early in the morning to kind of claim their spots. And as you establish yourself as a trader in the pit, whatever that meant for the particular crowd and the particular culture in that floor and on that crowd, you'd have less of a hassle kind of reclaiming your spot every morning. But in other places, in San Francisco, the market opened at 6:30 in the morning. I'd be on the floor at 4 with a bunch of other people. The floor didn't open till 4:30, but you'd have to get there to the vestibule, sit in the elevator bank, waiting for the floor to open. When the floor opened, everyone speed walked or raced to their pit to claim their spot. A couple of hours before trading even began, just because where you stood affected your ability to see business and to interact with the business that came into the floor. I think that's the prehistoric co-location. Is where you stood physically. Now it's just a matter of putting a server in, a few feet away from wherever you need it. But back then you actually had to stand there. But, claiming your bit of real estate set off a number of arguments, and those were ones I had as well. Some great insults were thrown at people at the time too, when things got heated about where you stood and where you wanted to stand.
I think that's a great description on how you describe it as like the old way of co-location. These days we have servers co-located and everyone's fighting for that. So yeah, that's a great way of putting it. So tell us about when you moved on to Hull Trading. How did you get a position at Hull Trading?
So I knew some of the Hull guys from, I traded a 10-year pit. That was my first badge, was in the board, and I traded 10-year note options. And I knew some of the Hull guys from that, and also from the neighborhood in Chicago where I lived. And my wife actually worked for one of them that he was on a board. So I left Apollo, came back to Puerto Rico briefly. And Hull at the time had their firm and their market making business, but they were also backing a few traders. So I got in touch with the guys I knew, and they're like, "Yeah, definitely come in, see if there's a fit, and we'll back you." And I went in for my interview, and all was going well. But then I was the best part of a day at Hull talking to different people, but all of a sudden, more of the partners who were on the market making side, on the regular vanilla trading group side, started coming in, and they just turned around and said, "Listen, we can continue to talk about backing you as a trader, but we'd like to have you part of the regular trading team here if you want to consider that." And that's how that happened. Hull was at the time very well known. They were one of the bigger users of trading technology. At the previous firm, we used a third party, like many people did, use a third party options pricing system that you tweak. And we had some developers that kind of adjusted. I mean, they were somewhat malleable, and everyone was working on their own system as well. And so many places used a third party software, but Hull at the time, Timber Hill, and a place called G-Bar, they were known because they had their own systems. And the Hull traders actually had handheld computers. So there were a regular presence on the floor of the Hull guys. So they offered me a job to go work with them. I said, "Yeah, absolutely. That's great." I knew some of the guys already. I knew I'd get along with them. And so I thought it was a good fit, and it ended up being a very good fit for many years.
Okay. And earlier you brought up the point that when you went for a few of these interviews to try and get a job, they asked you a lot of questions. There were some math questions and sort of some problem-solving questions. Do you recall any of the questions that you were asked in the initial interview at Hull Trading?
Yeah. So the Hull guys asked me, let's see, there were ones that kept coming up. One of the guys said, so you think you're okay with numbers, right? And I said, "Yeah, I think I'm all right." And he said, "Really? What's 3/5 of 700? So it's just arithmetic, but at the time you had to think quickly and get these things done in your head. So it was somewhat relevant. And then they asked about the Sears Tower, which I believe has a different name, but you could see the Sears Tower from the office we were in. So he said, "You see the Sears Tower there? Can you imagine a stack of pennies from the bottom all the way to the top of the Sears Tower?" And I said, "Yeah." Like, "Do you think that stack of pennies would fit in this room?" And so that was an interesting one. And it's one that we asked just to see how people think. And I know there's a different version of ping pong balls inside a Boeing 747, things like that you read about that even Google is asking now. And then there was another one about the NCAA tournament question was a classic Hull one, where they ask you, and I don't know if you're familiar with it, if the college basketball ends their season with March Madness, which is a big 64-team tournament that takes place over a few weeks. And in fact, one of your other episodes, I think they were talking about the amount of betting that goes on around March Madness. Well, Hull participated in that. Everyone on the floor did. But there was a question that we asked. You find out where the candidate's hometown is, and it's like, okay, Joe, the NCAA has decided to host the entire tournament in your town. How many games do you have to schedule? And if you're familiar with the way the tournament brackets go and it's single elimination and all that, usually people would start thinking, okay, there's 64 teams, so the first round's 32 games. And then the next round is 16 and 32 plus 16. And as you see them going through that arithmetic in their head, you're like, come on, I don't have all day. And how long is this going to take you? And, you start getting them stressed. And, I think maybe one guy got it right out of the gate, But usually it was a good way to get them a little off kilter as they're trying to do all this arithmetic in their head. And then you tell them, okay, wait a second, let me ask you this. And again, you could only ask this question to people that knew how the tournament worked, which is mainly anyone in America, but not necessarily in London or Asia. Like, okay, you start out with 64 teams. How many teams win? You say 1. How many teams lose? 63. How many games do you have to schedule? I see. So it was one of those, trying to stress them out a little bit while they're thinking about numbers, just to be somewhat realistic. There were other things that other people, it was actually get multiple candidates in one room and start asking questions and see who answered first and all that. We didn't do that.
Okay, well, you obviously passed the interview, so
Yeah, no. At that point, to be fair, at that point, I'd already been trading a little, a couple of years. So I was more of a lateral hire, although I did start out as a clerk for a few months, while they get comfortable and they figure out where they want to put me and all that. But yeah, definitely for the rookie guys, those were the kinds of questions that you got asked.
Sure. So when you first started there, you already mentioned that Hull was one of the few trading firms at the time that actually used their own systems. Was there anything else about Hull Trading that was obvious to you when you first started, that Hull Trading was not your regular trading firm?
Well, the way they took risk, and you notice, I stood in front of the Hull trader in the 10-year pit, who would become my coworker later on. But so you saw the way that they approached the trading side, and you had different kinds of traders. Some were more cowboys than others. Some were more aggressive and actually would lose their tempers or would want to jump on trades just to trade. They would trade out of boredom. The Hull guys I knew didn't do that for the most part. They were very systematic about following the way that they were pricing the options and the way that the order flow was coming through. So they wouldn't trade if they didn't have to. They wouldn't participate just to participate in general. And while they could trade as big as anybody else for sure in terms of capital, they wouldn't necessarily put themselves in a position to be sucking up all the liquidity just because they could. So they would participate along with the other traders. They would take the lead in busy markets just because they had better technology. So in terms of an interest rate move or a big number coming out and adjustments that you have to make to volatility or your forward curves, Hull would have those much quicker than anybody else. So they were more confident in their trading. And one of the things I was taught early on in terms of options trading was you have to trust your model. And that's much easier to say when you're a place like Hull and the model is your own and it's dynamically tweaked and you're more aware of how it works and who's behind it and how it's being implemented than if you're using a third party thing. So the Hull guys definitely had that mentality. Now we weren't, the expression was sheep monkeys. You still had a degree of latitude, and sometimes the computer wasn't faster than the way the floor was going, and you had to start, paying over sheets or under sheets while the system's caught up. But for the most part, they were very methodical about how they traded, and they were, although it was understood that they could be as big as anybody else, they weren't flaunting that. They didn't have any need to stand out in a trading crowd.
So with that being said, did the way that you trade change when you came into Hull Trading?
Yes, it had to. Well, the first thing was I went to a different pit. So I went from having spent time in the 10-year note trading and then in the bond pit trading options, I went to equity. But mainly, you're trading now as part of a bigger group. And we had, I was in the OEX, the S&P 100, which was super busy. I doubt anyone even knows what that is anymore. But back then, it was supremely busy, much more so than the S&P 500. And we would communicate a lot with each other in terms of the levels we were seeing in our particular corners of the crowd. Just because the crowd was so big, things would trade, and we would make sure that we weren't getting crossed just because something's trading at the wrong price 100 feet away from you. So we communicated a lot. We trusted the system a lot. And that was also, it was a relief and an adjustment that all of a sudden you're looking at a machine and it makes you it can make you a little lazy in terms of, okay, if the price isn't the price I have showing me on my theoretical pricing screen, then I'm not going to trade it. You didn't want to do that, but your way of participating in trades changed, and the way that you went after some trades changed. So rather than wanting to be a small part of any ticket, you wanted to be a big part of good tickets and no part of some tickets. And you had more awareness of that because of the systems and because of the communication that was kind of triangulated across the traders and clerks that were working with us.
When you need to build up your team to handle the growing chaos at work, use Indeed Sponsored Jobs. It gives your job post the boost it needs to be seen and helps reach people with the right skills, certifications, and more. Spend less time searching and more time actually interviewing candidates who check all your boxes. Listeners of this show will get a $75 sponsored job credit at Indeed.com/podcast. That's Indeed.com/podcast. Terms and conditions apply. Need a hiring hero? This is a job for Indeed Sponsored Jobs.
Ever watch a stock rip and think, I could have nailed that if I had real capital? The truth is, many capable traders never reach their potential, not due to lack of skill, but lack of scale. Trade the Pool was built to solve exactly that. A firm designed for serious individuals who want access to the U.S. equity markets with meaningful buying power, up to $200,000 without committing their own capital. Get access to virtually every stock and ETF. Go long or short freely with the flexibility professional traders expect. You're evaluated on one thing: your ability to manage risk and execute with consistency. Meet the standard, and you trade at scale. No subscriptions, no ongoing commitments. Whether you're still refining your strategy, a trader with experience who hasn't yet broken through, or a seasoned professional simply looking for more capital, Trade the Pool is built to meet you where you are and take you that next step further. The markets have evolved, access has evolved. Now, so has the way traders operate within them. Trade the Pool.
So you're referring to models and systems here. How much discretion did you have to use compared to how much of it was really a matter of just sort of following the models and the systems that had been developed?
The way we wanted to trade, I mean, it was, I didn't always agree with this, but it was really a blackjack model, right? You're just trying to capture bid offer. You're not trying to put a position on. You're not trying to make necessarily a big bet on volatility, or certainly not delta. You're just trying to trade the bid ask and capture that all day long. The markets weren't always. So my big discussion with one of the financial engineers was talking about blackjack. Well, there's always another hand that gets dealt. And as long as you got capital, you can participate in that other hand. In trading, if the order flow starts going one way and all of a sudden you only have put buyers, well, you're going to be, as a market maker, you're going to be a put seller. And you can talk about bid offer all you want, but if no one's selling anything, then you're not going to have anything to buy. So every now and then you have to step outside and say, wait a second, which way have we been accumulating positions here? Maybe we need to alter what we're doing and be a little more aggressive than the system is telling us to be, just to come back to within our risk parameters, which were communicated across the floor with some regularity. So we know if our and then this is something I don't think everyone did, but we were all aware of what our downside risks were and what our upside risk curves look like. So we're told, down 5, this is our P&L, down 10%, this is our P&L. And we had a certain amount of tolerance for things. And when you cross that, you have to start covering it. So then you would use your discretion to find the best trade to cover that without giving up too much edge. None, if you could, but if you have to give up some, then you have to try and minimize that. And that's when your skill as a trader and your ability to be, your pit awareness came through, because then you'd know where to go for that kind of risk covering trade rather than just the normal participating in the order flow that comes in.
Okay, so it was kind of a bit of both.
Yeah. And we were telling the guys, listen, ball's going up. You need to move the market higher. The skew's moving this way. I mean, we would see that in the pit before the machines would pick it up. So you had to have that kind of pit awareness of what was happening, what was going on with the order flow, what was going on with the market, and relay that to the machine. Now it's changed because all the order flow goes through electronically, so the machine can interact with it as it's going through. I'm using machine generically for any model or anything that you're using to price options. But the better you were at communicating what you were seeing in the crowd, the more likely you were to have accurate and fast systems to deal with it.
Now, for someone who worked at Hull Trading like you did, how obvious or how prevalent was the blackjack influence?
It was, you were very aware of it. When you joined, you were given certainly when I joined, a copy of the New Market Wizards interview with Blair. So you were aware of whose name you were standing behind. And there was a fair amount of card playing on the off trading hours time, and a lot of chess playing by the developers and the financial engineers. But the whole blackjack thing, the whole have an edge, exploit it when you do, scale back when you don't. That was always talked about, and it was talked about in different ways in terms of what our overall firm risk was, what the different instrument risks were. So if you're trading in the equity index crowd, or if you're in the financial, in the fixed income crowd, all those crowds had their own different risk metrics. But it was always in terms of the whole, this is what we think our edge is. If you see something that's outside of this, then we want to bet big on it. And we were all aware of how Blair had made a lot of money. We were all aware of the Beat the Dealer book. When we went to the riverboat casinos, we were always mindful that we played good strategy in blackjack, just because we didn't want to come back to the office and say, yeah, I had no idea what the count was, and I lost money. That'd be a little embarrassing. So yeah, it was reasonably prevalent.
Yeah, when you first started your answer there and you said that you were given a book, I thought you were going to say you were given a copy of Edward Thorp's Beat the Dealer.
No, you know what? I remember looking for one after reading the interview and not being able to find it. I don't know if it'd been out of print. Yeah, no, it was a book I was looking for. And now I got to pick up his latest one, which looks pretty interesting.
Yeah, no doubt. I've started reading. I've got the Kindle version of it. I got it sort of pre-release because I did the interview with Edward Thorp. So if anyone listening wants to check out that interview, it's episode 109 with Edward Thorp. But yeah, I do need to pick up a hard copy. For me, hard copy is the way to go. I know, call me old school.
Yeah, that is old school. No, but it's the whole modeling thing. I remember I was just thinking now in terms of gambling. The NCAA tournament was a big recreational gambling thing that the guys did, along with what was called then rotisserie baseball, fantasy league baseball, which was done by hand or on Excel spreadsheets from data that you'd get from the newspapers. I mean, right now it's much easier to do all online, but at the time it was all very manual intensive. And I remember going to the off-track betting site with some of the guys from Hull, and one of them had a handheld, probably wouldn't be nearly as powerful as an old Nokia, but it was what people had at the time in terms of handheld computers. And he had designed a quick and dirty model to see horse betting. So it was a bit of a disease with the guys that trading there to make a model, try and model everything. That no matter what it was that you were doing, you're trying to pick it apart and design a model around it.
Did he have much success with it? Do you know?
It was meant to work, but the problem is the off-track betting place didn't cooperate. So what you needed to see was it really tried to capture the changes in the odds in the time leading up to a race, and then you'd place your bet right before from what I understood him telling us this. I mean, I thought it was the nerdiest thing on the planet to try and be typing into a microscopic Excel sheet on a handheld computer when you're out in the track on a Friday afternoon. But I think it was meant to work, but the odds flashed on the screen. They didn't stay up long enough for you to capture it, so you could write them down, or for him to put them in his little handheld. So that was a big flaw in it.
I'd look like a total nerd too if it made money, if it worked,
If it worked, no, we couldn't knock it too much. We just thought it was a lot of work, because every time the screen rolled through to the race he was looking at, he's like, everybody, wait, what was that? What was that? And inevitably you wouldn't catch all of them and it wouldn't work, but sometimes it did. And then, it seemed to have some science behind it in terms of just capturing the velocity of money.
So in 1999, Hull Trading was bought by Goldman Sachs. Just to recap on your experience there, what were some of the biggest things which you took away from having worked at Hull Trading?
The whole team aspect of it was very important. And when you got interviewed, fit was a big deal because they needed to know not only you were a good trader, but that you were a good trader in the way that Hull does things. And it wasn't also just about interacting with traders. You interacted with the financial engineers and the developers quite a bit. I mean, we were all in the office together. We all sat down for morning meetings. Everyone heard the P&L and risk calls together. So you did get a very strong sense of camaraderie and a sense of this is what we're up to, and this is why, and everyone has their own particular jobs. And it was a very good lesson in how to do things that are complicated and splitting jobs apart and getting the best people to do the tasks they're best suited for in order to get the best results you can. Now, it wasn't perfect and there were situations where, models break down and things just go awry, but because you've done it as a team, you react to that kind of setback better as well. Because there's a sense of, we went in together and we thought we had a good plan. It didn't work. There was never any severe pointing fingers or the what do you call them? The postmortems on good and bad things were always very healthy. And that I think was a meaningful thing. And some of it carried over to Goldman Sachs, having come off being a partnership, the whole fit and teamwork aspect of it, a much more competitive place to be sure, but there still was a culture of fit and understanding. There was a culture, and you have to understand it and be committed to being a part of that.
Yeah, and that's one of the things that really stood out to me when I interviewed Blair on episode 85 is that his comments around the team aspect. I thought that was very cool to hear about.
It was a big deal to him, and he did walk around the floor. He knew, not around the office, and he knew everybody that was there working for him, and he was a good resource to have around. But he was a visible presence on the floor.
Mm. So after the buyout in '99, what were you doing at Goldman?
So the guys that I was working with at the time, I was running I was the senior trader in San Francisco office, which was 3 people. And trading Microsoft and the Qs had just been listed over there. The opportunity came for me to move to London with Goldman. So a year after the buyout, I packed up my stuff and we moved over to London. So, everyone's pretty excited to have Goldman Sachs buy us. I mean, we understood the mystique of the firm and the lore. But at the same time, we were a bit nostalgic because we were a small firm. We all knew each other. We were like, now we're part of something that's enormous. And, how's that going to work? I was actually pretty excited. I knew the reputation Goldman had, and I thought I'd really just got into Goldman through the back door. And I'm sure some people there would absolutely agree. But I was pretty excited, and they offer to move me over to London and trade over there. No idea what I was walking into. But I was pretty excited.
So tell us a little bit about how you managed the transition from going from a floor trader to now trading behind a screen.
That was hard, and it was an ongoing project for a while because the first thing, I talked about how physical and competitive the job was. Well, that's a hard thing to turn off as a trader, that you're now sitting alongside your coworkers. And you're interacting with a screen, and at the time, phones. Now it's even less of that, but at the time it was mainly pointing and clicking, and then picking up a phone and talking to somebody. That was a big change because you're used to the energy, the noise of the crowd, and you feed off of that. You kind of get a sense of the rhythm of the market by what's going on in the noise level. So if something, and just across the floor, so not just your pit, but other things too. So the bond, big order comes into the bond pit, you trade in 10 years, you're going to pick that up from noise. before you even know what's going on. So you lose things like that instantly. And I was a bit lost. The guys when I moved to London, I was one of a couple of guys that came from the US side. Most of the whole guys in London and whole Goldman that joined Goldman were coming from the Frankfurt office. So they'd been trading off floor for a few years already. So they knew. For me, it was hard. The quietness of it, the relative silence was hard. I mean, it was a noisy trading floor, and there were people talking about stocks and screaming and yelling. Some things, but it was nowhere near the level of energy that you get from a trading floor. And you also have to calm down a lot. You can't be as excitable. You know, the orders aren't coming as fast and furious as when you're in a trading crowd. So you're interacting with things that come via chat message or even email, maybe a phone call. You have a lot more time to think about what you want to do and how you want to price something, because the rest of the stuff is actually just being done live on a screen, and you're not necessarily interacting with it that much. That was very strange. It led to me being told to please calm down and not be as aggressive on the floor with salespeople, things like that. I mean, again, I hate to admit it, but it was one of those things where, like, you have to be told, listen, you're not on the trading floor anymore. Calm down. And you take that to heart, and you're wearing trousers, slacks and a shirt now rather than khakis and sneakers and a tattered tie around your neck. You're like, okay, I guess I need to shape up here.
Yeah, and did you personally know many traders who actually did really struggle and actually failed to make that transition successfully?
I did, because as I was leaving the PCOS, it just happened to a lot of the guys that were in the Microsoft crowd with me. So again, their main edge, I mean, they were sharp guys, they were risk takers, they were good with the numbers, and they were good Microsoft option pit traders. Once that went away because the order flow dried up and it was going to the CBOE in Chicago, all of a sudden they're like, wait, there's not as much order flow for me to interact with. There's not as many people in the crowd for me to trade off of. Maybe I'll go upstairs. And it just didn't work. Some of them didn't really fit the mold for an institutional trader. I'm not saying I did. I just, again, we got into the back door to the institutional side because of the Goldman buyout. I ended up having a reasonable upstairs career, but not everyone did. And the guys that went off on their own from the floor, that was their edge. And once that was gone, they had to find something else to do.
Was there a particular line of work that most of them actually went into? Like, did they find other jobs, maybe not as a trader, but still something related to financial markets?
Yeah, in finance, I would say from memory, a couple went into retail brokerage, and one of them actually was pretty successful because he had options knowledge that gave him a bit of a sales edge when it came to talking to clients about, advising clients. Not every retail broker is a former options trader that can talk reasonably about the opportunities for a retail account in trading options, such as they are. So that gave him a little bit of an edge in a new kind of venue. Other guys a lot of guys went into real estate, and again, this is San Francisco in the late 90s. So we didn't realize the market was going to crash, but a lot of them went into real estate and did that or mortgages for a while. The funny thing is, once you're not on the floor with them anymore, you have very little in common with them. You don't interact with them as much. And back in when I left and moved to, I didn't just leave and go upstairs. I left and went to another country. So without Facebook and LinkedIn and Twitter and everything else, it was a little harder to stay in touch. So you do lose track of them. Not all great stories. Some of them did fine and reinvented themselves. We were by and large pretty young people in our early 30s, kind of on the high end. So it was it was a forced change for some of them.
Okay. So you worked at Goldman Sachs for a few years after the buyout, and then you also went on to UBS for a couple years, and then I think you did about 10 years at Merrill Lynch. Do you just want to give us a quick overview of the sort of things you were doing at those companies?
Yeah, so Goldman and UBS was all index option trading. In Goldman, it was in Europe. So the IBEX mainly, I didn't do that much Eurostox, which was the dominant contract once the DAX kind of fell apart. It yielded to the Eurostox. I traded mainly FTSE, SMI, and IBEX options while I was at Goldman. It was an interesting time, but different way of trading than what I'd done at Hull. Now you're making prices for clients, and you're making prices to kind of take a position. You have to have a view, and you hope that you get a way to unwind it with other client flow or other market flow. But you have to be comfortable with the position. So the position sizes were much lumpier, and risk management was different at that point. And that's one of the strengths of the Hull system, was to be able to decompose your risk management. And that's one of the reasons Goldman bought Hull. So it was basically using the systems I was familiar with, but doing new things with them. UBS was back in the US, and I traded S&P options and the SPY options that came online while I was there. That was a new product that came out. But then when I moved to Merrill, I switched, and I went more into my initial role there was a hybrid derivatives and equity finance role. So what ends up happening is banks have a lot of stock inventory that can be used in a variety of different ways, and through the derivatives desk, I should say, end up with long and short positions that can be optimized. And because I had some experience with equity finance at the time, I kind of ended up in a newish role that Merrill put together, which was a hybrid equity finance derivatives role. And I did that for a couple of years, including some corporate action trading, which again had a equity finance kind of bent to it. But then just after the crisis hit in 2008, in early 2009, Merrill offered to move me back to London to run the Delta One desk over there. And that's what I've been doing up until now, when I just left. So that was ETFs, index swaps, and stock index futures.
Okay. And as someone who was running a trading desk, what sort of things did that involve?
Well, then it becomes, your main thing is, are you interacting with clients are you prepared to interact with the clients in the correct way? Because that's where your order flow and your positions come from. So you've been trading for a while, you understand the trading and risk management side, you have your market views, you understand how you're going to make prices in the instruments that you're trading. So, but now you have to worry not just about managing a handful of traders, but also making sure that you're interacting with clients in the correct way. So, because that's where your money comes from, orders from them, commissions from them. And that involves giving them ideas. It involves working with the salespeople so they know what you have in your book and what they can help you in or out of. It involves, dealing with the different personalities on the desk and understanding how they want to trade and how you need them to trade, and see who is going to be better at this kind of pricing and who's going to be better at this other kind of pricing. Just allocation of resources. It's a little different than just running your own options book. Now it's a mini business within the investment bank.
So, let's sort of move on from this a little bit. But before we do, it's safe to say that the majority of your trading career this far has been really in the professional, institutional side of things. Is there anything that you think retail traders could adapt from how you've traded over the years?
Let me think about this, because the main thing I would say is that the information edge that an institutional trader has is no longer as wide a gulf over the retail trader or the retail investor as it used to be. And I'm not just talking about CNBC, but there are so many resources that are available at zero or manageable cost to folks on the street or not in these institutions, that I think that's a big thing. You talk about a lot of the regulations that have come through and a lot of the market structure, how the market structure has changed. It really has benefited the end investor in many ways because of deeper liquidity, tighter bid-offer spreads, more access to markets, and that can be good and bad. because it can lead to over trading or people getting involved in instruments that might not be suitable for them. I had you see things in some commercials that you're like, wait a second, this isn't suitable for these people. How are they making this available to anybody on the street? And you need to have a little bit of market understanding before you start trading some of these things. But by and large, the edge that an institutional trader would have had over somebody on Main Street has diminished. It's not gone by any stretch. Obviously, you have much more visibility to everything that's going on. But because things are more electronic, because a lot of things get reported real time, because there's access to a variety of different resources for information, not just the news channels, but just online and the wires, I think that they can really go in thinking, okay, I'm not as at a big disadvantage. Because the other thing that's happening is it's all gotten much more competitive and heavily regulated on the institutional side. So, it's really no longer the case that one bank has one client that's a market moving client wrapped around their finger, and they're the ones that are seeing how this works out. Most clients can't do that. They have a duty to find the best price for the structure and shop things around. So things get around the street quicker, and it's not, and it leads to more competition on the pricing side, and it leads to better execution for everybody, but also just things get communicated quicker. So I would say don't underestimate the fact that the playing field is not as distorted as it certainly used to be.
Yeah, okay. I think that's a fair comment. So as you've now moved back to Puerto Rico and you're essentially no longer an institutional trader, you're just trading your own money, you're essentially trading a retail account. How has someone like yourself, with that experience, approached this? Like, how are you now approaching things as essentially a retail trader?
Sure. The first thing is the position size matters. And I've had to manage risk in a variety of different guises. So I'm comfortable with risk. I'm comfortable taking risk. The position size now, I have to think about it a little bit. It's not more, it's no longer a case of, am I comfortable being long, X many millions or short this, or now it's more like percentage of the capital that you're using, and you have to be more tactical, and you have to, you like a position, how much capital are you going to allocate to that? That was never a consideration I had as an institutional trader, or even as a market maker, just because the pockets were that deep, and I was very fortunate in that regard that things were managed, that kind of thing was managed away from me. So the first thing is really think about position size and think about how you're going to use, how I'm going to use leverage, which is another edge that we have, is there's readily available leverage. If used judiciously, that's really the way that, you can maximize your edge as a person sitting behind a desk trading this, that, and the other thing, and testing a variety of things out. Getting used to being by myself, that reminds me back to the pit trading days. So although I spent most of my career on the institutional side, the pit days are the ones that I enjoyed the most. That's where most of my fond memories are, just from the way trading happened. So that's taken me a little bit back to those days where you're a little bit isolated and you think about what you want to do and how you're going to get it done. So that's how I'm approaching the business that I'm doing right now. What do I want to trade? How can I trade it? How big? How small? What's the right way? And then what information is out there, and what systems, or how am I going to apply the systems I have? What else can I get? I mean, right now there's also the exploration phase of what's out there, and there's a lot of noise, but there's enough out there that's good that you can extract value from in a different way than what I'm used to. So it's been really a throwback to my floor days where kind of on your own, even though this time it's my own capital at risk.
And also presume that the actual sort of trades that you're taking are quite different as well. Like your actual strategy is vastly different from how you would have been doing it over the past, 20 or so years. Can you talk to us a bit about how you've approached that side of it too?
Certainly. And this is one of the things that on the institutional side, you're reacting to client order flow. You can our ability to put positions on. And you always hear institutional traders say, oh, I'm a great trader and I have this on and I have that on. But because of regulatory pressures, a lot of that went away. You simply couldn't be a prop trader sitting on a sell side seat because the regulations wouldn't allow it. So you had to react to client order flow. And your edge was where you sat, the fact that you would see many different orders, and you had to formulate a market view before you priced anything for a client. That's gone. Now I get to do whatever I want to do. So the whole idea generation bit, which we used to do for other people, now I get to do for myself. And I can put them in context of something that I want to do, that I'm thinking about. A lot of ideas that maybe, we had on our desk wouldn't be interesting to clients that we were talking to because, they are pharma traders and all they care about is what the next pharmaceutical stock that's going to gap up 15% is. They don't want to hear that you think the high of the day is a buy because it's going to continue tomorrow on the main index. Because they don't want to trade indices and things like that. So while as a trader you want to trade a liquid thing that's going to give you a chance to do things around it, when you're in an institutional desk, you're just reacting to order flow. So thinking about what I wanted to trade, that took a bit of time, where the liquidity was and where I thought I could put some things together to extract value. And it's been a mixed bag of success so far in the last really 6 months of just under 6 months of actually doing it. But I'm reasonably optimistic we'll be able to do something cool.
And so you've also been experimenting a little bit with models as well.
Yeah, nothing super sexy because at the end of the day, I wasn't a financial engineer. So that involves seeing what I've been able to buy or get, and now thinking about programming languages and how quickly I can teach myself to do some rudimentary stuff, possibly hire somebody and work with them, which I know in some of your other episodes, guys have said they've had to do that. And I think that's going to end up being a part of what we do, simply because there is a lot of data out there. There is value in that data. There are ways to look at it to try and make money trading. Clearly, people do it. I think I've come across a couple of different ideas that I want to try out. So that involves modeling them out and working with global data providers and different number crunching apps to try and see test things out.
Absolutely, yeah. Just moving on to this, just a completely different subject. ETFs, trading ETFs. This is something you mentioned that you might like to speak about when we were initially talking prior to this. And trading ETFs is obviously something you've done very much on the institutional side. Why have ETFs been an attractive product for you to trade?
I came across ETFs in '96. That was, I think, a couple of years after Spiders first came out. And at the time, I thought, this is great. It's a way for me to trade the whole index without having to trade futures, which I wasn't qualified to trade. I mean, you have to open a futures account. I didn't. That seemed complicated, even though I was already in a trading job. It was just a very efficient packaging of things that I wanted to trade. And that's how I first came across it. As time's gone on, I just really appreciate the variety of products that there are now in terms of thematically, you can find a passive instrument that's easy to trade, cheap, and easy to execute because you can get in, you can get out. The pricing is, for the most part, pretty reasonable. In terms of the bid ask, they're liquid. They're taking over the liquidity profile of the U.S. exchanges, really. So it's just been a good way to express views long term or more dynamically because of the trading aspect of it, and the fact that there's just cheap ways to express these views just made it a very, very interesting product to me.
So for traders who are new to trading ETFs, is there anything important which they should perhaps be aware of?
Yeah, I think if you need to think about how you're going to use the product, and if it's going to be a long-term strategic hold and investment, then you can take your time, find the cheap, because they're inevitably, unless you're doing something that's really, really unique, like even Blair Hall's own ETF product. That's it. That's the only one of its kind. But if you're talking about a sector ETF of some sort or a broad index ETF, there's going to be more than one flavor of them. You can take your time, find the cheapest management fee, and buy that and hold it. If you're going to be trading, then you can worry less about what the management fee is and find the most liquid one. But it's worth looking into, and a lot of this information is out there on different websites, whether it tracks its underlying benchmark true or not, or does it get out of kilter and end up being something that trades at a premium or a discount more often than not. Now, while that creates its own type of opportunities, if you're looking for momentum trading opportunities, or you want to get in and make a trade in pharmaceuticals or make a trade in I don't know, whatever, some random sector, then just find the most liquid one, because that's all you want. You don't necessarily, if it costs 2 or 5 more basis points in terms of the annual management fee than another, it's not going to be as important as, is there borrow in it? Are there options listed on it? Are there, is there good daily volume that I can interact with? Those are the important things. But if it is a strategic hold or something for your retirement account or something like that, then definitely take the extra few minutes to find the cheaper one in terms of management fee and buy and hold that. I think a lot of the growth ETFs have had in the US is because a lot of them have options listed on them. And that's another cool thing. If you find an ETF you like or a theme that you like, and it has an ETF and it has listed options on it, even if you never do anything on the option side, the volume is going to be enhanced because of the options activity around it. Or in the event that you do want to get involved, then they're listed, they're an option, they're an alternative to actually trading the underlying security.
Can you just take a second to explain how those management fees work and when they actually take effect?
Sure. Most ETFs have, all ETFs have it listed and broadcast what their management fee is, an expense ratio, some call it. And that simply is the amount that BlackRock or Vanguard or State Street charges to run the product. That effectively drips out of the net asset value of the fund. So the price that you see on a screen during the day in the spider, that's a bid and offer. But every day, that basket of stocks that's behind that ETF is calculated and priced. And that's the net asset value for that fund. Now, the net asset value might be a little different than the last price spiders or whatever ETF traded. But from one day to the next, in a market that doesn't change, the price of the ETF will drop by that day's worth of the management fee. So we're talking about fractions of basis points on a daily basis of management fee drip out. So if you have a stock that doesn't move, if spiders goes from January 1st to December 31st and does not move, the ETF net asset value will be 9 basis points lower than it was at the beginning of the year, because that's how the fee gets calculated and basically charged by the manager. It's on a daily basis, and it just gets extracted from the net asset value of the actual fund. It's nothing that's too visible on a day-to-day basis because it's fractions of percent. So from a trading standpoint, it's not something that you're going to notice from one day to the next. As a holder, a long-term investor, one will want to consider to pay as little as they can, simply because they have been compressed so much. Now, some of the products that are more bespoke, that maybe they have currency overlays, or it's a unique strategy, an alternative strategy, they'll be more expensive. That's something that tracks a regular index, like S&P 500 or a Dow. That's to be expected, that there's a little more special sauce that the manager is doing in order to manage it and put it together. But for the most part, the broad-based stuff is reasonably cheap.
Okay. And where can we find out how much those management fees are for each ETF? Can we just go to somewhere like ETF.com?
ETF.com is a very good resource for ETF information. I think they also have comparison kind of tables for similar products or products that track similar underliers, that they tell you what the management fee is. The issuers themselves, by regulation, have to publish what they are. They're going to be on any Bloomberg screen of this product description. But yeah, ETF.com is as good a resource for anything related to ETFs as anything else, just because it's so thorough. But yeah, that information is out there and public. The makeup of the baskets is out there as well. If you care about things like that.
Yeah, I mean, how much should we care about that sort of thing? Because, there are many ETFs, in most cases, there are many ETFs for each sector. Should we just be looking at the management fee, or is there sort of something else that we should be looking at? Like, should we be looking at the constituents of that ETF?
I think before the constituents, the tracking error, and a lot of websites, a lot of ETF information websites are starting to kind of follow that and post on that, because it matters in things that are, the S&P 500 is very easy to track. MSCI emerging markets, not quite. So there was a big thing a couple of years ago with Vanguard talking about their emerging market ETF versus, I think it was iShares emerging market ETF, and how the tracking error mattered and made a difference to the return of the investors in that. So for things that aren't supremely straightforward, somewhere in the realm of an S&P 500 or a S&P sector, the tracking error metric should be reasonably easy to find. Now, not necessarily be obvious. There's nothing you want to set up out calculating yourself. But then you want the lower tracking error. That tracking error will come from what the manager is using to track the index. And then if you want to get a little more sophisticated, then you want to see what they're actually holding, because in some cases they'll hold the perfect index, in others it's not feasible or convenient to do so they don't. And then you just want to follow the tracking error. And again, the lower the tracking error, the better your returns will be in terms of the benchmark.
Excellent. All right, let's leave it at that for now. Where can listeners go to find out more about you?
Well, I don't have too much of an online presence. I have a Twitter account that I talk about random things, so might not be that trading heavy, but so I'm sorry to disappoint there, I guess.
What is your Twitter handle? Give it out, because I'm sure someone will want to follow.
Sure, it's at EL_9UAPO. It's basically El Guapo. It's an old joke from the Three Amigos movie. Being the only Puerto Rican in a variety of trading floors and trading groups ends up inevitably with nicknames.
I can imagine. Well, I'll be sure to include a link to that in the show notes as well. Jorge, thank you very much for coming on the podcast, man. This has been really interesting. It's been great to hear your story, and I appreciate it.
No. Thanks for having me. It was a really good time. I really enjoyed the stuff that you've done, and I congratulate you on that. And you did scoop everybody on Ed Thorpe, so congratulations to you on that one.
Cool, man. Cool. Thank you very much for sharing. We'll talk soon.
Thank you, buddy.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Best thing that's ever happened to you financially. Go.
Easy. Sold my car on Carvana. Amazing offer.
Really? I hit 200 on the scratcher.
Did the scratcher come to your house and hand you a check?
No.
How many scratchers did you hit to get that? I hit a button on Carvana.com once.
Okay, that's fair.
It's like the lottery, except you always win.
Not like the lottery at all, actually.
Exactly. Inexplicably good. Offers worth bragging about. Sell your car today on Carvana. Pickup fees may apply.
What would your trading look like if capital wasn't the constraint? That's the reality for most traders. It's not skill holding them back, it's size. Trade the Pool changes that. Step into the U.S. equity markets with up to $200,000 in buying power without committing your own capital. Full access to stocks and ETFs, long or short, executed with the precision and freedom serious traders expect. Your performance is measured